final meeting of the year, and we will begin with a roll call. Vice Chair Jennings?
Here.
Trustee Abbott?
Here.
Trustee Avasti?
Here.
Trustee Chandra?
Here.
Trustee Faulkner?
Here.
Trustee Linder?
Here.
And the chair is here. Council Chin, would you like to qualify our online members?
Yes. Trustee Chandra, can you please let us know the address from where you're teleconferencing from? And is it the same as what's listed on the agenda?
I believe so. 97 Gresham Lane, Atherton, California.
Yes, that's the same. And is the location from where you're teleconferencing from ADA accessible and open to the public?
It is.
And have you posted the agenda on an area where it can be publicly seen at the location? And if a member of the public wishes to be heard from that location by the board, could they be heard?
Yes.
Trustee Chandra has been qualified under the traditional Brown Act teleconferencing rules. Trustee Faulkner, can you please tell us the address from where you're teleconferencing from, and is it the same as what's listed on the agenda?
Yes, 420 Starville Drive, Cape Carteret, North Carolina.
And have you posted the agenda in a place where it can be publicly seen?
Yes, I have.
And is the location from where you're teleconferencing from ADA accessible and open to the public?
Yes.
And if a member of the public wishes to be heard from the location from where you're teleconferencing from, may they be heard?
Yes.
Trustee Faulkner has been qualified under the traditional Brown Act teleconferencing rules. All votes shall be roll call votes due to the remote appearances of these two trustees. Thank you.
Thank you, Council Chin. The orders of the day, we have a time certain item at 11 a.m. and I will endeavor to take a 5-minute break at 10 a.m. Appears we do not need to waive sunshine. And I will first accept any public comment on any item that is generally before this board, but that is not otherwise on the agenda. Is there anyone here or online who wishes to speak for 3 minutes? There is. Can that person please go ahead?
Good morning, Chair Horowitz. My name is Brad Imamura. I would like to extend my welcome to the new executive officer, John Flynn, and I have spoken with him and hope to meet with him in person, hopefully maybe after the new year. So anyway, and again, Happy New Year to the board. A question I have is, where can I find or has it been posted, for the past fiscal year, ending June 30, the overall returns from the Federated Fund? Where can I find that?
Well, actually, on today's agenda, we will be approving the PAFR, what does that stand for exactly? Popular Annual Financial Report, which has return numbers. So it is an attachment to today's agenda, which you can find online.
Okay, that's great.
Okay.
Thank you. And again, I would like to also extend an invitation to all board members to meet with them. I know as a taxpayer and I guess you could call a shareholder in the Federated Retirement Fund, I would like to get a chance to meet the board members. I know there's been resistance in the past. I don't understand why that is. It is somewhat awkward if you were in my position to speak to the board and the board sits there stoically and I can't have a one-on-one conversation. So it's very awkward, and I don't think it's somewhat it's not normal. So anyway, I'll just throw that out there. Again, the extended invitation. I'd like to know who the board members are. I am a beneficiary. I'm also a contributor to the fund as a taxpayer, and hope to get the know the board better. I would like to also understand and hopefully throughout the year we can find a somewhat a strategic plan to get the funding up. I know it's been around 60%. Maybe that's changed. If you can maybe clarify that for me. And that's very uncomfortable.
Okay,
Thank you very much, and I again appreciate the work of the board.
okay.
Thank you.
Thank you, Mr. Moore. Again, on today's agenda, we will have a presentation from Chiron where we will review the current funded status, which I believe is 61%. And you can see more detail when we get to that agenda item. Is there any other people waiting for comment online or in public? Seeing none, we can proceed to the consent calendar.
We have closed session first?
Oh, okay. Then we will proceed to closed session.
Yes, sir.
Yep. Thank you for keeping me honest. It's a full-time-
Recording stopped.
That's a full-time job. trustees will return to the table. Do we have our trustees back online?
Yes.
Recording in progress.
Great. We will now move forward with the agenda. I believe we need to approve consent calendar.
Oh, before we do, Chair Horowitz.
Oh, I'm sorry.
May
Yes.
I report out?
Please.
Thank you. For the closed session item 1A, the board took action to authorize legal counsel to seek amicus status and to draft an amicus brief for the board's consideration. The vote on the, that passed was a yes in support of the motion was Trustee Faulkner, Chair Horowitz, Trustee Jennings, Trustee Abbott, Trustee Linder, and Trustee Chandra. The vote against the motion was Trustee Avasti, and there was no abstentions. Thank you.
Thank you. Now we will do the consent calendar. Is there a motion to accept the consent calendar?
So moved, Mr. Chair.
We have a motion from Trustee Linder. Do we have a second?
I second.
We have a second from Vice Chair Jennings. Any public comments? Any discussion? We'll do a roll call vote. Trustee Chandra?
Aye.
Trustee Faulkner?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Jennings? Doing that again? I know you too well, that's the problem.
That's the problem.
Was that an aye?
Aye.
Thank you. Trustee Linder?
Aye.
And Chair votes aye. We will move forward to item number 2, death and survivorship. We will have a moment of silence for those who have served the city and who have passed. Okay, thank you. Agenda item 3, oral update from our CIO, Mr. Polani.
Thank you, Mr. Chairman. Good morning, trustees. We have a pretty busy investment agenda section today with reporting of last calendar, third quarter, calendar third quarter, fiscal first quarter. Okay, there I got it. But as always, before I get there, performance estimates. Thankfully, these estimates do not include yesterday.
Do not include yesterday, okay?
So I can give you a rough back of the envelope if you want. But as of 12/17, these numbers are from Makita. Fiscal year to date, up 3.54%. And this is for the pension plan, and healthcare is 4.29. You probably want to take off 1.5% or so from yesterday's thing. Though the market's rebounding today, so.
Are they still up this morning?
Yeah, it is, as of
Okay.
now, I think. Yeah.
All right.
I
so
have a
this-
question on that.
Yeah.
I'm just curious, because I think, I'm confused why the markets would react so negatively when I think it's obvious that the board would not be reducing the rates further in the future. I think, maybe 2 times, not 4 times. I don't think that's a big surprise, and everybody did anticipate the 0.25 drop that the Federal, Reserve Board did.
Yeah.
And it did come through.
Yeah.
So for them to react like that, I know markets are not logical,
Yeah.
but can you help me, why that
Yeah.
might be?
Well, my guess is as good as yours, but.
Oh, no, I
so I
think your
think
guess
you
is
said
better than mine.
you used the word obvious. So, we assume here that market participants are rational.
Yes, we know they're
Decision
not.
makers, and
Yeah.
that's a big assumption right there.
Mhm.
I think part of the problem is that valuations are extremely high. The market's the most expensive it's been in the last 100 years,
Mm.
except for the dot-com bust.
Oh,
So
okay.
all it takes is a very small trigger for it to drop big,
I see.
right? And so, like you said, I had the same feeling personally that Powell was going to come out and say
Yeah.
that next year's hikes are going to be more measured and fewer.
Mm-hmm.
But obviously, the market was in 2 minds, didn't know if he was going to say that or not. There's all the tension between the new White House, the soon-to-be new White House
Right.
and Powell, and there's just a lot going on there.
Right.
And so when he actually came out and said very specifically, you're not going to get 4 cuts next year.
Right.
It spooked the market, and all those high-priced technology stocks, whose earnings are very, very, very much in the far future, took a dive. And so I think. So
Was it more tech? Was it more high tech that took
well,
the
I think it
dive?
was across the board, and when
Oh.
the market falls, everything falls. But obviously, the higher priced stocks tend to fall more. The more expensive stocks tend to fall more.
So who brings it down? Is it just the Joe Blow investor, or is it truly
It's-
the investors?
There's a former boss of mine said it very well. There's only one reason markets go up, because there are more buyers than sellers, and there's only one reason it goes down. There are more sellers than buyers, and it's the average
Mm.
person, right?
Okay.
I'm not sure there was a lot of institutional selling yesterday. I don't
Yeah.
think so.
Okay.
Institutional capital is capital like us.
Yes,
We're just watching the market, right?
Right.
We're not reacting to the market.
okay,
So a lot of it is sentiment driven,
okay.
but I think there will be volatility because prices are so high.
Yeah.
And so you can expect pullbacks of 5 to 10% in the next few months. I personally think, this is just me,
Yeah,
that those are buying opportunities. Because I think as I've written before, we are entering an era of deregulation. One thing to contend with is that rates are going to be higher for longer, and that's a reality.
yeah.
But I think in an era of deregulation, and when the sentiment is pro-market and pro-business, I think the market will do well. But the market's focus will also shift back to profitability next year. That's my thinking, is after the first quarter. Now, of course, there's going to be some euphoria around the inauguration, and there might be some momentum. But once we get past the first quarter, it's going to be important to go back to basics and fundamentals. Are companies making profits? Is there real money being made? And I think those are the stocks that will be rewarded. So that was pretty long
No,
answer.
it's
to your
very good.
question. Yeah.
I
Thank you.
appreciate it. Thank you.
Any other questions from trustees? Okay.
Okay, so we will move on to item 3B, and I believe we have Casey? Yes, Casey Boyer and Dinesh.
Great, thank you.
Great. Good morning, everybody. I'm on a little bit different setup, so hopefully everybody can hear me okay. And give me just a minute and I will share my screen.
We can hear you.
Great. Okay. As always, a pleasure to get to present to you all quarterly. Over the last, I would say, year and a half, what I've been presenting quarterly has not changed too much, just based on the overall private equity market, and presenting Q2 to you here today. That continues to be the case. From Q1 to Q2, we saw very small movements. Really, the portfolio was par over the quarter. Just analyzing or looking at the net multiple, it went from 1.86 to 1.85. So there's not anything that I'm going to point out from a quarter over quarter change that was significant. But what I will say is, one thing that we were able to do post Q2 was get back to your portfolio some distributions that had kind of been building throughout 2024. So throughout September and October, we did distribute back a little over $5 million to the Federated portfolio. And then if you'll look here on page 2, just a reminder that we're now making commitments out of Series 2. Series 1, they're both the exact same strategy. We're working very closely with Dinesh and the team on the investment strategy, the pace, investing in the same types of investments, but just through this new series. And so Series 1 is completely committed. There will still be dollars invested. So there's underlying investments, fund investments that will still be calling capital, but that should slow down over time. And then Series 2 is where we are actively committing to new funds, new co-investments, new secondaries. And so we basically have a kind of annual plan that we're pacing out to, that we're continuing to commit through. You'll see in Series 2, the multiple went from 1.4 to 1.2. That does not mean there was any write-downs. That's not the case. It's simply there's been more capital, more invested dollars being put into the ground. From Q1 to Q2, the Series 2 portfolio went from $3.7 million of dollars invested to $5.7 million invested. And so you'll see that change in multiple driven by new investments that are held out at one time that haven't had time to develop just yet. If you think about where we are today, we're in December. We have released Q3 financials for your portfolio. And again, very much par over the quarter. We did not see a ton of movement one way or the other across the portfolio in terms of valuation. So when you see me here in another few months, it will likely be a very similar story. We're still waiting overall for the private equity market to pick up on realizations, distributions. We always think that, historically, Q4 has been a bigger driver of distributions as private equity funds are trying to sell companies before year end. We'll see if that was the case just from kind of seeing the movement over the quarter. I don't know if Q4 will kind of make up for the rest of the year, but we did see a handful of distributions here and there from co-investments. I'm going to move to a broader outlook and showing here on page 10 an analysis by investment type, and on the bottom a benchmarking analysis where we're showing your quarterly returns compared to a peer benchmark. Again, you'll see the very small movement from Q1 to Q2, and then you'll see the benchmarking information at the bottom. We're sitting kind of squarely there, above median, in between median and first quartile on kind of both metrics. That is Series 1. For Series 2, as I mentioned, the net return on the TVPI went down based on additional capital being put to work. Of course, we're still actively deploying capital here, so this net TVPI will definitely take many more quarters, many more years to develop as we're continuing to invest, and as the investments continue to mature and actually start producing returns that we would expect within the portfolio. The quartiling metrics are never available for the first couple years of a portfolio, just given the earliness of the investments, and so we will definitely start showing that when they become available, but for now, just a little bit too early. You'll see the performance by investment type there at the top of the page. We've seen an early nice returning secondary investment, which was primarily from an investment that we bought at a really good discount. So it's nice to see some of those very opportunistic secondaries really benefiting the portfolio early on. And then you'll see the co-investments, which have done pretty well right up front, with a couple of them being written up. I'm going to take a pause and just open it up for questions, or if there's anything else that Dinesh or the team would like to add.
Okay, thank you. Are there any questions from trustees?
I have one question,
Please.
and I'm just wondering if, oh,
Yeah.
it's not on? Okay, I'm just wondering if the changing expectations for the interest rates that we just talked about earlier, or the current market conditions are, if we have any sense of how they might impact what's happening with the ability of our private markets to return.
Mm-hmm. Yeah, so from my perspective, the one area that it is really affecting is distributions or realizations, companies being sold within the portfolio. Yeah. That has slowed down tremendously, and it really is due to the higher interest rates, yeah, where the sellers were able to buy the companies at much lower interest rates. The buyers now are buying at much higher interest rates, and so they're having a hard time agreeing on a price that works for both of them. So in turn, we have seen a drop in selling and realizations across the whole entire private equity portfolio. Yeah. We haven't seen from our side a huge change in return expectations, in confidence in the market, in kind of that ability for private equity to continue returning capital. We underwrite a lot of co-investment transactions, so we're looking at specific companies and working alongside GPs as they're valuing companies, and they're having to be very, very involved and operationally focused in order to get to valuations and returns within their portfolio that they would like to have. So they don't have the ability to drive return based on financial engineering. It really has to be focused operationally. So that has been a concept that's been taking place within the buyout world for a long time. So I don't think that's much different than what they would be focusing on anyway, but it definitely has affected the realization exit market.
Thank you.
Any other questions or comments? If not, we can proceed.
Okay, all right, thank you. So
Thank
over
you.
to 3C. Thank you, Casey.
Yes, thank you.
Over to 3C, and I believe we have Laura on the line. Laura and Chris.
Yes, good morning, everyone. Happy early holidays. Thanks for indulging us to present virtually, since it's an interesting travel day this close to the holidays. So Colin Kowalski is going to start us off with the public version of the private markets report, and then I'll discuss the total fund.
Okay.
Great, thanks, Laura. I'm going to go ahead and pull up the slides. I'm getting a notification that the host has disabled my ability to share slides. Oh, and now it looks like it's working. Thank you.
Okay. You need but to ask.
All right, I'll go ahead and get started. So this is our private markets report as of the second quarter. Page 1 here is the standard dashboard for the multiple programs. The top two are the private equity programs, which have already been discussed, and then the bottom 4 are the programs that I'm going to go through today. We have the private debt, real estate, real assets, and venture capital, sort of organized here by relative size. You have the different statistics across the board for each of these programs, but I'll draw your attention on this page to the right side of the page here, and that's your performance metrics. As always, you have the IRR, internal rate of return for each program, and then on the very far right is the PME IRR, so that's your public market equivalent benchmark. That's what these programs would have returned if invested in their appropriate public market equivalents. So across the board, if you compare each of these programs to that benchmark, all of them except for venture capital are outperforming. And so it's great to see that each of these programs continue to have that premium over the public markets that we would expect. In aggregate, the remaining value for all of these programs combined is $774 million, and the IRR for the program is 8.5% since inception, a strong result. The next page here jumps into the private debt program. You can see the chart there in the middle shows the allocation over time. As of the second quarter, this program had a 4.3% allocation relative to that 3% policy target, and so it remained slightly overweight 3%. As of the end of the second quarter, the total IRR return for this program has been 6.3%, as you can see at the bottom of the page. Page 3 talks about cash flows and commitments. This quarter, or during the second quarter, a new commitment to Silver Point Distress 2 was made in the amount of $5 million. The next two pages show performance for each vintage year as well as the individual partnerships. One thing I'll point out is if you look at the right side of this chart, you can see the performance metrics. We have the DPI, so that's distributed over paid-in ratio, the TVPI, so that's total value, that's your NAV, plus distributed capital over paid-in, and then you have your IRR. You can see here that we've added a peer DPI and peer TVPI. That's new for this quarter. The peer group provider Burgess has that available, and so we went ahead and add that as another performance metrics that you can use to compare. Up and down the board, there's a lot of strong results here. I'll point out vintage years 2017 and beyond look particularly strong. There's a handful of underlying individual partnerships that have also had strong results within private debt.
I have a question. What's in the
Sure.
What's in the peer group?
The peer group is a group of similar type funds from the same vintage year. And so the benchmark provider Burgess aggregates different funds of that same type for that vintage year and creates an aggregate median, and that's what you're comparing against across those metrics.
Thank you.
Page 7 shows vintage year and geographic diversification. Commitment pacing and vintage year diversification are key points within any private markets program. And so if you look at the top left, that pie chart shows the vintage year diversification by remaining market value. The private debt program is a bit of an older program. I think the first year was 2010, and so you can see it's very well vintage year diversified, pretty evenly spread out amongst those vintage years. And so that's an important aspect of the program, and it's great to continue to monitor that and see that it's such. The next program is real assets. So this is a bit of a newer program. You can see the allocation chart here starting in 2015. The policy target is 3%, and so this allocation has sort of worked its way up towards that 3% target, ending the second quarter at 2.3%, so slightly below target there. The program has returned 9.6% on the IRR basis, so strong result on an absolute basis there in aggregate. There was one new commitment during the second quarter, and that's Hull Street 3 in the amount of $7 million. And then again, the next two pages show performance across vintage years, as well as the underlying partnerships. Again, some strong results for these underlying partnerships, although a bit more of a mixed bag when you compare it to peers. I'll point out that, again, this is a newer program, and so many of these funds are still very new. You can see some of the marks are marked NM, that's not meaningful. So if there's a track record under 3 years, we believe that's, sort of in that drawdown phase, and the performance metrics aren't really that meaningful, especially when you compare it to peers. So that's the case with a lot of the ones here. Page 13 again shows the diversification statistics. You can see the vintage year chart. This is pretty well diversified across vintage years, although still a large remaining market value in that 2016 vintage. And then this program is more geographically diversified than many of the others. You can see about 45% in the global developed markets, and less in North America, only 34%.
Can I have a question? I have a question. If you go back to page 11, and you've got two of the energy-related ones that were fairly significantly negative. IRRs, 58% for energy co-invest and minus 88 for creatine co-invest. Crestine co-invest. Yeah.
So those two are co-investments that have been written down to zero value, and I think it was about a year and a half ago that we publicly reported to the board. So these are individual investments that usually we make investments within funds, so you don't notice the complete losses, which
Right.
During investing there are losses that happen, but these
Yeah.
are more noticeable because they are line items. So in these cases, both of these underlying companies faced liquidity challenges, business challenges in the post-COVID environment, and as a result, were written down to zero.
Okay, thank you.
And what assets specifically were they invested in that had terrible performance?
So they're both related to the energy industry. We can follow up privately because we don't disclose in
Yeah.
public session what the private investments are, but energy specific.
Yeah.
Okay.
Great, thank you, Dinesh. I'll move on to real estate. So this is a bit of an older program for the plan. You can see starting in 2015, the allocation at the end of the second quarter was 3.8%, and that's slightly above that 3% target. In aggregate, it's returned 6.2% on an IRR basis since inception. No new commitments this quarter, and that's been a recent theme. As you'll see in the next few pages, there hasn't been many new commitments during the the more recent time period that's been challenging for real estate markets. The next two pages talk about performance. You can see by vintage year as well as by individual partnership. Again, many of these underlying partnerships have done really well relative to peers if you stack up the performance metrics here. Again, on page 18, you can see the more recent commitments. There hasn't been much activity from that regard. In aggregate, the total real estate bucket has returned 6.2%. From a diversification standpoint, again, this has strong vintage year diversification across the board. Most of the allocation is within that 2017 bucket, although there's strong representation amongst other years as well. And then finally, I'll wrap up with venture capital. This is the newest private markets program starting in 2020. It has a 4% target and still well below that, although it's been working up closer to that target over time at about 1% as of the end of the second quarter. On an IRR basis, it's been a challenging few years for venture capital in general. This program has been down 2.8% on an IRR basis. Again, many of these commitments are still really new, and so these results are still in their infancy. No new commitments for the second quarter, and then the final page here shows performance by vintage year and underlying fund. Again, many of these are really new commitments with fairly immature returns, and some of them still being not meaningful. The next handful of pages here, we've provided some background on private markets in general. I'm not planning to go through it, but we're happy to answer any questions. I'll go ahead and pause for any questions from the committee, or if there's anything staff or Laura wanted to add at this point.
Great, thank you so much. Are there any questions from trustees? Any further questions? All right, thank you so much.
All right, well, we will take the baton from Laura and give it back to her.
Okay. We're approaching the 10 o'clock hour. I don't know if the trustees wish to take a 5-minute break, or should we plow through? I'm sensing plow through. Okay, go.
All right, over to you, Laura. Thank you.
Sounds good. So I think Colin's going to share the full as well. Here we go. Just to start off on our slide that has the bar charts with markets recently, I know there was some discussion with Trustee Jennings and your CIO regarding what happened in the markets yesterday. I at one point Googled yesterday, why is the market falling, just to see what the common sort of sentiment was, and it seemed to be a very common Google search after there was a rate cut that was expected in the market. So we all are not the only ones that are, amused by the behavior yesterday. So the S&P 500 was down about 3% yesterday. And then securities that are considered to be more sensitive to interest rates, like small cap stocks and REITs, were down even more, 3,000, which is U.S. small cap stocks was down 4.4% yesterday, and real estate investment trusts were down 4%. However, if we look at the quarter-to-date performance, the S&P 500 is still up 2.2% for the quarter-to-date period since the end of September through yesterday, and small cap stocks are slightly positive as well. We also see some positive performance quarter to date still from high yield bonds, even though investment grade bonds are down, as well as areas outside the US in terms of stocks. But if we go back to this report, which goes through the end of September, we had really phenomenal year to date returns. If you look on the left here, it's not often that we get a 22.1% return for US stocks in a 9-month period. And if we look on the right, the third quarter was hugely positive as well for, you don't see any asset classes on the left side of the center line here with a negative return through the end of September. We saw strong returns across the board, but riskier assets tended to do better during the third quarter, and we'll see that in your portfolio as well. China had announced some stimulus measures towards the end of September that really boosted emerging markets towards the end of September. Of course, China has been more challenged since the election and possible tariffs and other things in the news. But was actually yesterday, when the U.S. markets were down quite so much, China was up 0.8% and brought emerging markets into the black as well yesterday. So as you know, in your reporting, we have a watch list for managers that includes any manager that's underperforming its benchmark over the 3 or 5 year period. We continue to work with your investment staff over on a daily and weekly basis to monitor all of your managers. In general, even the managers that are underperforming for 3 and 5 years might have a since inception number that's quite strong, or might be outperforming a peer group in just a challenged environment. So we continue to monitor all these groups, but per your policy, they are now on the watch list. And we will take a look at asset allocation next. So if we take a look here on page 30, you can see that all asset classes were relatively close to their policy targets. All were within target ranges as of the end of September. The total market value increased by $124.3 million from investment gains during the third quarter. So there was a net cash outflow of about $2.5 million during the quarter, but your portfolio went from $3.15 billion to $3.26 billion. Looking at performance on the next slide, there was a 4% return for the total portfolio for the 3 months ended September 30, which brought the first 9 months of the year to a 9.6% return, and the trailing 1 year return for your plan to 15.6%. Quite strong, more than double, really almost triple the assumed or expected rate of return. So really strong return in the context of our expectations and taking advantage of the market environment. And if you look at the asset class performance further down the slide, you can see that the historical returns that we're looking at have been driven recently by U.S. equity and global equity. U.S. equity up 20% for the first 9 months of the year, really incredible, mind-blowing numbers there, and 34.5% for the 1 year period. So, also within the peer group, you can see that the peer group median for the 1 year period was U.S. equity up 28.8%. So your managers have really been able to take advantage of not just keeping up with the U.S. equity markets, but outperforming as well. On the next slide, we'll look at some other asset classes. International and emerging were quite strong also. You can see here 24.5% one-year return for international and 25% for emerging. International was up 8.5% for the 3-month period ended September 30, and the asset class and your managers were in the top quartile of the peer 3-month period and well above median for the trailing year. So again, strong manager performance. If we look at private markets, that's been a lot lower than global equity public markets recently. If we look at the 5-year return, though, private markets have had an average annual 5-year return of 12.2%. Any number longer than a year here is annualized, so it's an average annual return. So that 12.2% average annual return for private markets over the last 5 years has been one of the strongest asset classes in the portfolio and really protected quite a bit during years like 2022 when public markets were really challenged. The next slide takes a look at emerging market debt, which has struggled a bit recently given a long-short manager. But if you look at the 5-year return in the top fourth percentile of the peer group, so strong long-term returns there. Low beta is designed to diversify your portfolio. It has lagged a little bit over the last year. Strong returns, doubling its benchmark over the 5-year period. And we do expect that hedge funds probably outperformed public markets in some market environments like yesterday where you have public markets. The next slide will wrap up with some of the other diversifying asset classes here. In particular, I'd point out long-term government bonds. Long-term government bonds are really sensitive to changes in interest rates, but they tend to be the only asset class that is going to have a positive return in really, really challenged market environments. So that's a source of diversification in the portfolio that has done well over the last year. I want to skip ahead to talk about risk in the portfolio a little bit to page 60. So 60 and 61 have 3 and 5-year risk statistics here because, of course, we don't want to just look at return, but we want to look at risk in the portfolio as well. A couple of measures of risk that we want to be on the higher end are the Sharpe ratio and the Sortino ratio, the two charts here on the right side of the page. So you want a higher number there, that's better. It's a measure of risk-adjusted return. How much return are you getting per unit of risk? So the first bar chart here shows that for the trailing 3-year period, your total return has been above the peer group median. The standard deviation or volatility has been well below the peer group median, 8.2 relative to a median of 9.2. And so that's brought the Sharpe ratio, risk-adjusted return over 3 years, to right around the first quartile. And then on page 61, we look at 5 years, slightly longer period here. Again, you see returns outperforming the peer group, volatility lower than the peer group, really strong risk-adjusted measures. So that was a summary of the fund performance through the end of September, but I'm happy to delve further into any topics or questions you might have.
Great, thank you so much. Any questions from trustees? Okay, any public comment out there? No? Okay. All right, let's move along.
Okay, then I'll move to a brief review of the healthcare trust. Asset allocation is on page 28. We have the same slides in here with the economic environment and the watch list, just in case somebody were to pull up just this report and not the other one. We want to include all of our standard sections, but here on page 28, you see a total balance, total market value as of the end of September of $435 million. There were $21.3 million in investment gains in this portfolio during the third quarter, and current allocations are close to policies and within target ranges. In the next slide, we see performance. As you know, the healthcare trust uses a subset of the managers in the pension fund and some more index strategies as well, so I won't go too far into manager details, but just looking at the high level here, you can see that there was a 3-month return for the quarter ended September 30th of 5.1%. That brought the first 9 months of the year to 10.6, and the trailing 1-year return to 18.9. As you know, this healthcare trust is a bit riskier. It targets a slightly higher rate of return than a lot of health and welfare funds in the peer group do. That's worked out quite well in the recent market environment. You can see that in the Invest Metrics Health and Welfare rank there, the fourth line down. You can see top quartile returns really across the board, slightly below top quartile in the 28th percentile for the trailing 10-year, but having this be more growth-focused portfolio has really worked out well for returns and growth in the portfolio. And the story, for individual asset classes is the same in terms of returns being driven by global equities and being really outsized double-digit returns recently. The risk statistics here that I'd point out are on pages 40 and 41. So if we take a look here, you see the same story. You see very strong returns relative to the peer group on average over the last 3 years. You see higher volatility here than the peer group, as I mentioned. So that's in contrast to the pension. But even with that higher volatility, the returns have been strong enough that the risk-adjusted return or return per unit of risk that you've accepted has paid off. And we see that as well on page 41 with, again, high returns, also high volatility, but still a high risk-adjusted return. So I'm happy to take any questions on the healthcare trust performance as well.
Great, thank you. Any questions from trustees? Okay, hearing none from the public. None? All right. Some very happy returns.
Yeah.
Thank you very much.
Thank you. Okay, I think we're up to agenda item 5, oral update from the CEO. Mr. Flynn.
Good morning. ORS has successfully completed the recruitment for a senior accountant. I'm delighted to announce that Nam Gao, a current ORS employee, has accepted the position. He will start in the new role January 19th. ORS is continuing the recruitment for a senior office specialist position, and we hope to have that filled in January. We have posted the recruitment for the now vacant, or what soon will be vacant, accountant position that Nam will be leaving. Nam, just a little background, Nam joined ORS in 2016 as a temporary employee. He served as our temporary senior account clerk for less than 2 years before officially becoming a City San Jose employee as an accountant in June of 2019. Nam stepped up to serve as a senior accountant on a higher class assignment. He seamlessly contributed to the audit and ACFR process this year, helping everything go smoothly despite the challenges we faced in the staffing in accounting. ORS has completed its review of the ORS procurement policy and will deliver a revised policy to the governance committee later this afternoon based on ORS and finance's collaborations. The changes were fairly minimal, but better aligned the policy with existing city definitions. The policy is expected to be delivered to the boards in January for discussion and action. ORS lease is due to expire March 31st. We are working on finalizing the space analysis. I anticipate coming to the boards early in the new year to request approval to negotiate and execute a new lease agreement based on our findings. ORS is in the process of preparing numerous RFPs. Legal services due to expire the end of this fiscal year. The ad hoc team for legal services has met a few times, and with the goal of publishing the RFP by end of day tomorrow. Similarly, for actuarial services and actuarial audit services are due to expire at the end of the fiscal year. That joint ad hoc committee has met and has given direction to staff to finalize the RFP, and our internal goal is to have that published by tomorrow as well. Lastly, government services, which we extended the contract at our last board meeting till end of March. Staff is working internally with the goal of publishing the RFP today. So quite a bit of movement on the procurement front. A lot of work done leading into the holiday closure. So thanks for staff and board members for being so generous with their time. City of San Jose is replacing their existing phone system and hardware with Zoom's phone citywide. ORS is working with Central IT and their vendor as part of this implementation. This implementation started earlier this week. ORS has experienced various stages of outages during the transition that started earlier this week. Staff has been proactively reaching out to missed calls and responding to notifications. We have also posted a notification on our website for how members should proceed if they do encounter some of the outages. We are seeing that come more and more to a closure as we finished up yesterday, but I still believe that there's still some outstanding numbers that are in process of being ported. ORS office will be closed during the City of San Jose's holiday closure, December 31st through January 1st. We will have minimal staff working to escalate any urgent issues as they may arise. We will meet with members by limited special appointment, ideally scheduled in advance. Lastly, I just want to end with I believe I sent everybody at the dais here a season of gratitude note, and I feel it's important that I share it publicly as well. I have much to be grateful for this year. Supportive and understanding family and friends have to be at the top of that list. Leaving New Jersey and coming here, my wife has been tremendously supportive of me and this endeavor. So for her, she earns my highest thanks. My colleagues in New York, in how they accepted my decision to leave and still gave me the support and encouragement, has been tremendous to me. And then my new family here at ORS, the supportive staff of their new CEO that has tons of questions. I'm humbled by their clear dedication to our mission of service to our membership. Supportive board members that dedicate their time and energy to help drive our organization in support of our members. Lastly, I was accepted into the City of San Jose, whether it was our council liaisons, city staff, or the city's leadership team. Everyone has been willing to make the time to meet with me and answer all of my questions. I'm truly grateful to be here to serve ORS. With that, any questions?
All right, thank you so much. We certainly appreciate your making the trip out here from New Jersey, and
I did it by drone.
of course, that's the preferred method of transport now.
Just one. So, John, you feel optimistic about the lease arrangements?
I feel that we will be able to accommodate the space needs that we have.
That's what I meant, yeah.
We're in negotiation, so I prefer not to go into too much detail,
No,
if that's
fine.
okay. But if you'd like to schedule something offline, I'm happy
That's
to,
right.
to lay it out for you. But I believe that we are on a path that will allow us to not be homeless on April 1st.
Thank you.
Very good. That's reassuring.
Yes.
Any other questions from, any other trustee questions? Any other questions from the public? Seeing none?
Very good.
Thank you, Mr. Flynn. Item 5B, oral update from our city liaison. Ms. Davis.
Last meeting.
Good morning. I wish I had something lighter to report for my last report, but I have to report what is before me. So the city manager sent 2 emails in December so far. One was on December 4th regarding cost control measures for the current fiscal year. There have been some 2 quarters actually of lower than expected sales tax revenues, and so they are implementing. The city manager's office has requested that all the departments implement cost cutting and containment measures for the current fiscal year. And then on December 13th, she also issued operating budget development planning memorandum, and that also asks for a number of things, including recommending ongoing reductions or eliminations or restructuring lower priority services and programs so that we can bring the general fund for the fiscal year 26 into structural alignment, identifying alternative delivery methods and funding sources, et cetera, et cetera. There is I would say at this point it's a partial hiring freeze that was put in place effective immediately, and there may be more to come based on or depending on what happens with the 5-year forecast that gets released in February. So stay tuned for that one. I'm sure my successor will give you more details as they arise, but unfortunately, it's the current fiscal situation for the city is trending downward, and looks like there's going to be some cost cutting in the next couple of years.
Okay. And that's it?
Yeah, I'm sorry. Like I said, I'm sorry to have to give
You
a
couldn't do a
city
good news,
update.
bad news sandwich? You couldn't?
Yeah, I wish I
okay.
could. I guess the good news is this is the last time you have to see me.
It's sounding very Nixonian. Okay.
My going away, terming out celebration will be tonight at the Janet Gray Hayes Rotunda. You are all invited. It starts at 5, so please, you're welcome to attend.
Thank you.
And if you happen to have anything purple to wear, that's preferred. That's preferred.
Any questions from trustees or from the public?
I assume they haven't decided on a council district to take over for this?
Not that I know of. The council meeting, I want to say it's January 14th that they're going to be deciding. I'm looking at so on January 14th is when they will make the appointments for all the committees.
Okay.
The mayor will release by January 10th what his recommendations are. Sometimes there's horse trading on the council for committees. That's pretty rare, but it has happened in the recent past. So I just want to put that out there that nothing's final until the vote.
Okay.
But you might be able to get an indication by January 10th. And either way, I mean, I still live in San Jose, so I'm planning to do a turnover with whoever is here. And I know that Pam has asked to stay on the police and fire board so that she will also be providing that stable liaison role.
Okay.
Well, I do want to say it's been a pleasure having you here, okay? Your intellect, your capability is respected and acknowledged, and as a trustee, and as a city employee, I wish you all the best for what the future takes you. I'm sure you'll do great, because I've always been very impressed by what you bring to the table.
Thank you, Julie.
Okay.
Well, Julie stole my thunder, so now I feel bad that I'm not there in person, but Councilmember Davis and I we're contemporaneous. We began our service together, and it's been, I've really appreciated the mutual respect. We haven't always agreed, but we've always discussed things in a productive manner with the goal of making the city and our plan as strong as it can be, and I greatly value that, so thank you.
Thank you.
Thank you.
It's been a pleasure.
And let me add from the chair's seat how much I appreciate your liaison work the entire time I've served. Your engagement, your interest is not always paralleled by other members of the city council, and pension stuff is not always terribly fascinating and interesting, but it's vitally important. So we appreciated all of your input and your engagement over the years, and we certainly wish you luck in whatever future you may have.
Thank you. I've always thought that what's interesting and what's impactful are not necessarily fully overlapped, so it's important to pay attention to the most impactful.
Very much so.
Yeah.
Thank you.
Okay.
And I just wanted to say thank you for your support for me when I was selected by the city council. You definitely helped, and I've definitely seen your influence in the time that I've been here. So I want to also express my appreciation.
Thank you.
Right. Any further comment from trustees or public comment? Seeing none, we will move forward to item 5C, which is Mr. Hallmark. You managed to arrive expeditiously.
All right.
Good morning.
Good morning.
We are here for this presentation to present the preliminary valuation results for the OPEB plan. And we too had some travel issues this morning, so Jackie King is participating via Zoom. And so you'll hear her voice come in during this presentation. So much like with the pension plan, the primary purpose of this valuation is to develop the city contributions for fiscal year end 2026. Unlike the pension plan, this under this plan, the member contributions are fixed at 7.5% of pay. So really the only thing we are doing is looking at the funded status and developing the contributions for the city. Members are not affected. The other thing to note here is this is predominantly a closed plan. The only members who get the full benefits are Tier 1 members who did not elect the VEBA. And so the members who elected the VEBA and the new hires are in the VEBA program. They can get a catastrophic disability benefit under this program, but they're not eligible for the full benefits. And so there's some different dynamics because of that going forward. Here on the left, we're showing the preliminary measures of the liability and the assets. The bars are the liability. In dark blue are the members currently receiving benefits. The gold are members who are no longer working for the city but are entitled to a future benefit, and the red are the active members. The green line shows the assets, and you can see we improved from about 59% funded to 64% funded for this plan. So we are above the 60% threshold. We started not too long ago with very little assets. So this program has, the funded status has been improving rapidly. I do want to note the total liability for this plan is a little over $600 million compared to over $5 billion for the pension plan. So we're talking about a much smaller liability than the pension plan. On the right-hand side, you can see the contributions. The purple are the member contributions. That's the fixed 7.5% of payroll for the members eligible for full benefits, and then the gold is the city's contribution. We do note all of our results here are based on the explicit subsidy provided. There is an implicit subsidy that we've described to you that the city pays on a pay-as-you-go basis through the active health premiums, but it does not affect the trust. So we're focused, the results here are just focused on that city explicit subsidy. One of the interesting things here, though, is that normal cost is the red line. That's the cost of benefits attributable to the current year of service. And everything above that is going to help pay for the unfunded liability. And so even some of the member contributions are going to help pay off the unfunded liability, and really all of the city's contributions are going towards the unfunded liability. Just quickly looking at the investment returns, we had on a dollar-weighted basis about a 9.9% return during the year. That'll be slightly different than what Makita reports because they report a time-weighted basis instead of dollar-weighted. We assumed 6%. Our 5-year average return has been just slightly below 6%. But that provided about a $15 million gain this year. Wanted to just look at the membership trends briefly, starting with the blue bars here that show the active members who are eligible for full benefits. So the count of that has been going down and continues to go down as those members retire or otherwise leave the city. No new hires are coming in, so that's the closed part of the plan. Then, actually, I just want to show you the pre-Medicare group. These are the retirees who are not eligible for Medicare. And so that group has also been declining as the population that is receiving these benefits ages into Medicare. And so when we add in the Medicare group, you can see that the retiree population is constant or growing. We also there are some people who have only dental or only in lieu credit. So if we put all the groups back together, in aggregate, it's been going down until we add in the active group who's only eligible for the catastrophic disability benefits. And so that's the portion of the plan that's growing. Their benefits are substantially lower. And so as we shift to them, that normal cost goes down and some of the other costs go down as well. Turn it to Jackie to go through these next slides.
Hi, good morning, everyone. The next couple of slides, we're going to look at the change in the unfunded actuarial liabilities, which is for short the UAL. So what we're looking at this slide is we're looking at the change in the UAL from the last valuation to this valuation. So as of 7/1/2023, the UAL was about 259 million, and it's decreased over the last year to 230 million. It's a decrease about 29. The biggest driver of that was your great investment returns, which lowered it about 15 million. And then you had your contributions greater than your trade water amount. So you're paying down the UAL. That's where you're getting a gain. That took it down about 7 million. We had some assumption changes this year, which lowered it even further. And then as far as liability experience, it was less than $1 million, but there were two factors in that liability experience that offset each other. So there was a reduction due to demographic gains. So what that means is how the experience of your participants compared to the assumptions that we have in place. So are they retiring as expected? Are they terminating as expected? And so what you did is you saw a gain from there, but then that got offset with the premium experience. And what that means is that the premiums came in higher than we expected this year, and that was for the Medicare eligible premiums. They came in higher than we had projected from last year. So those two numbers offset each other, so you see a small number there.
Can I ask a question?
Sure.
Go ahead.
Can you explain a little bit about the demographic gains?
Sure. As far as like the demographics, so we have a bunch of different assumptions in the valuations. We have economic assumptions like your assumed rate of return, inflation, all of that. And then we have demographic assumptions. So what those are is we have like rates of retirement, termination, disability. So based on the experience of the plan in the past, we come up with those assumptions, and it's the same assumptions for the pension and the OPEB plan. And what it does is we're assuming when are people going to actually leave the system? When are they going to retire? When are they going to terminate? And as far as then what actually happens in comparison to those assumptions, that's where we see those demographic gains and losses. So for instance, if in a plan like this where you're not necessarily like accruing a benefit, if someone retires earlier, younger than we assumed, you're going to see a loss from it, because now they're going to get that benefit for a longer period of time than what we had previously assumed. Same with, the termination doesn't really affect it as much in this plan, but probably your big ones are going to be your retirement and mortality. So if people live longer than the current assumption is set, you're going to see a loss because you're paying that benefit for a longer period of time than what we had previously assumed. So that's where you come, that's what gets classed as a demographic gain or loss.
Thank you.
So this slide is looking at the change in the UAL. So we just looked at it over just the last year, but this is looking at it over the last 5 years. So it's breaking it down. So we have all the same buckets, and then the true gray, in the past slide, they were combined into one liability bucket, but now we've broken it down by the demographics and the premiums in this slide. So just looking at anything below 0, you're lowering your UAL, so that's a good number. Anything above, you're increasing your UAL. So a couple of things to look at. You can see the big ticket items here are going to be your investment returns. Those are your biggest drivers right here. So you can see they kind of, they oscillate over time. It's the most changeable one that we see. You can see that you had some big gains in 2021 after those losses of 2022, and then you saw some, in 2020. And then over the last couple of years, it's been a little more stable. So if you were to look at we put the demographic ones in there, you can see those have a smaller effect. And what that means is that you're seeing a lot of the experience of the participants. It's pretty close to the assumptions right now, so we want to see that bar to be as small as possible. As far as the premiums, we have a little less control of that, and you can see it's a bigger driving factor than just the demographic gain loss. The good thing is, if we're looking at the contributions, in all 5 years, you can see it's lowering the UAL, and what that means is that you're paying more than your interest on your UAL and your normal costs. So that means that you're drawing down your UAL with those contributions, and that's always a great thing to see. And then as far as the assumptions go, those are always a big factor. Those comes when we change an assumption to best suit the experience of the plan. We did a big experience study, as you can see in 2021. That's why you see a big change there, and then in the last year, we saw a gain there, and the reason for that is that we lowered some of the trend rates, projecting the premiums going forward, and then we had very minimal benefit changes. I don't think we had any in the last 5 years. So that's breaking it down. If we look at the 5 years combined, you can see how the investment gains and losses, but that, even though it was very prominent when we split it out, it's a much smaller number here because they're offsetting each other. So the bigger numbers here to look at, the assumptions increased your UAL over the last 5 years, but then you had your premiums, you had better experience than expected, so that lowered your UAL, and then once again your contributions about the trade water rate also lowered your UAL in total. If we look at the breakdown of the liability, you can see this is just a pie chart splitting it out by whether you're in pay status, if you're active, or if you're terminated and due a benefit in the future, as well as if you're, it breaks it down as far as the Medicare and non-Medicare parts of the benefit. So currently, 69% are currently in pay status. So those are people that are currently receiving a benefit. The next biggest number, you also got a large percentage, 70% of the liability is for benefits that are eligible for Medicare. So those are people that are currently over the Medicare eligibility age, as well as anyone that's younger. It's the portion of their liability for the Medicare eligible. So that accounts for 70% of the liabilities. And about 20% of it is prior to Medicare eligibility age, and the remaining 10% is for dental benefits. So this is the projection of the contribution summary. So the first line, the members, that contribution dollar amount is decreasing, and that's expected as the members that are eligible for full benefits retire, because as Bill pointed out in that earlier graph, the active population is decreasing, and we do expect it to decrease over time. As far as the city's explicit contribution amount, that increased about 7.7% over the last year. The city does have an optional cap to cap the dollar contribution amount that they make, but that cap is about 3 times your current contributions, so you're well below that optional cap amount right now. And then the last little bit is that implicit subsidy, which also increased slightly over the last year.
So with that, we'll take any questions. These are just the preliminary results. We'll be back in January with the final and any potential tweaks to these numbers.
Great, thank you so much. Are there any further questions from trustees? Any questions from the public? There are none. Okay, let us move forward. Bear in mind, we do have a time certain item at 11 o'clock, so we may need to suspend this presentation if, depending how far we get into it. But let's move forward.
Okay. Okay, those were the preliminary OPEB valuation results. We have the final pension valuation. There were a couple items in your packet, both the PowerPoint and the full report. We're only addressing the PowerPoint, but if you have any questions about the report, we're happy to address those. Just reminder, you're almost through the actuarial calendar. We just this is the final pension piece, and then January's the final OPEB piece, and then we go dormant for a while.
Say it ain't so.
We always start our valuation presentation with this chart that was first published in the Harvard Business Review in 1965 about how pension plans work. The basics have not changed at all, but the fundamental equation that we have to balance over time is that the contributions plus the investment earnings have to equal the expenses and the benefits paid. So we are taking our measures of the plan in the valuation and really assessing where we are in the compared to our funding target. That's our funded percentage, and then tweaking the contribution dials to make sure that we keep that equation in balance. So with that, I'm going to turn it to Stephen here to go through the next section.
Okay. Is this working? Yes. So similar to one of the charts just shown on for the OPEB plan, we have a stacked bar chart here on the left showing the actuarial liability, with the red block being the active liability, the yellow block being deferred vested, so folks that have left employment with the city but are eligible for a benefit later, and then
Can
the
you talk into
A bit
Yeah.
closer.
a little closer. There we go. And then the here, I'll move forward a bit. Okay. And then the blue bar is the largest, and that is for members in pay status. So the lines we're showing there show both the market value of assets and the actuarial value of assets, which has some smoothing. The two values are pretty similar at these measurement dates, but you'll see the funded status, which is comparing the two, has increased from 59% on a market value basis to 61% as of June 30, 2024. Now, on the right side, we have a table showing showing these numbers by tier, I would point out, tier 1 has almost 10, more than 10 times the liability of tier 2, right? So tier 2 is much less mature, and tier 1, the funded status on a market value basis is went from 56.8% to 59.4%. In tier 2, there was a much smaller unfunded actuarial liability, and there the funded ratio went from 88.2 to 90.2. So again, a much smaller piece of the puzzle, and we'll see that on slide 6 as well. So on slide 6, we're looking at the contribution rates and contribution amounts. We're going to start on the left side, and we'll look at the city's normal cost and the members' normal cost. So these are contribution rates. You can see that fiscal year end 2025, it was the light purple is the member rate, so 8% of pay, and 11% for the city. That changed to 8.1 for members in fiscal year end 2026, and 10.5% for the city. So there's actually a slight reduction there in the normal cost. Now this, I guess if you add in the expenses as well, this is equivalent to what the cost would be if the plan was fully funded, right? So there would be no unfunded actuarial liability that was being paid down with interest and principal. So if we add in the interest on the UAL and the principal, it's a significant difference. So on the left side, the contribution rates in total are now 60.1% and 56.4%. Yeah, I guess we could take off the member piece. So this is now the city contribution rates are 52.1%, with 28.5% of that being interest on the unfunded, dropping to 24.2% for the fiscal year end 2026. So the smaller, right, the unfunded actuarial liability decreased, so the interest on that is a smaller percentage, but also the payroll increased, so that makes a difference. And when we look at the chart on the right, the contribution amounts, you can see so 234.3 million total, increasing to 241.8. So the dollar amount is increasing, but the percentage amount dropped, and that's a function of the payroll increasing, right? So you have a larger payroll. But I'd also like to point out on the right-hand side, we can look at both Tier 1 and Tier 2. So when we compare, so just Tier 1 is the bulk of the payment amount, right? So if we switch, so 206 million and 209.6 for fiscal year end 2026. But if we switch to Tier 2, you can see that's much smaller, 27.9 million and 32.2.
Can I ask, so when we look at that, we look at Tier 1, we look at Tier 2, do you have, FTE or positions that associate with that number? Like Tier 2 is 1,000 and.
We do. We'll get to those.
Oh, yeah. We have.
Yeah, I mean, in the comparison with the dollars? Because Tier 2 is so much lower, but Tier 2 is so much lower in liability and cost.
Yeah.
And so it'd be interesting to see if Tier 1, the cost is so high, but that's, a smaller full-time equivalent versus Tier 2. You know what I mean? I'm just saying.
Yeah, we do look at the membership. Yeah.
Yeah.
Is that? Oh, okay. Yeah. So we can compare the member cost. I mean, if you take away the unfunded, right? The unfunded piece is what's really driving the Tier 1 cost. If you take that away, I think that the two are probably not that dissimilar. Yeah.
Well, the Tier 2's actually larger.
Yeah, it's now a larger.
Now, in terms of even though the normal cost rate is smaller. Let me get this set up here.
So,
So
normal
the
cost.
tier 1 normal cost rate is about 25% total.
Uh-huh.
And tier 2, it's about 16%. Now, the split between the city and the member is different. But when you translate those to dollars, tier 2 is now 61 million, and tier 1's only 32 million. So we've really shifted the active employees to tier 2.
Right.
Yeah, it's.
But what's driving these additional costs is all the paying for the unfunded liability, right? And tier 2 just has a tiny unfunded liability.
Yeah, you can.
So it's really just that, the impact of that cost.
Okay, so moving to slide 7, we covered a very similar slide in the preliminary results, so I'll try to run through this quickly. But on the left side, we look at where the UAL started at the beginning of the fiscal year, and then move it to the end of the fiscal year, or fiscal year end 2024. The big picture is that the UAL reduced. So the contributions and investment returns reduced the unfunded, and then that was offset by 28 million of liability experience, which was primarily salary losses. And on the right side, we show a history of the different pieces of changes in the UAL. And what I would like to point out there, so anything under 0, right, is improving the funded status of the plan, so reducing the unfunded. And you can see the yellow, the investment returns on an actuarial smooth basis. There you can see in the past, the most recent 4 years, those have gone below 0. So that's good news. The returns are decreasing the unfunded. And if we add contributions, you can see that those have also been reducing the unfunded, more so in the most recent 4 years. And another, I would say that this is kind of a good story here, right? If we add in the assumption changes, those have gotten under control, right? So those are smaller recently. So the most recent 4 years are looking a lot better in terms of the direction of the UAL changes. Now we have had some headwinds if we add back in the liability, a little bit of headwinds there with recent salary losses, right? And then
Or increases.
Salary increases.
Yes.
Actuarial losses.
Losses, yeah, losses from an actuarial perspective, right?
Yes.
It's
But, think of your audience. So.
Yes, yes. Higher than expected salary increases, we should say.
There you go. So you gotta, really is the assumptions that you use for salary.
Yes.
You weren't reading the tea leaves as well.
Long-term assumptions.
There you go.
Okay, so yeah, and if we add all those together, you can see that, there was, what was the total, 700-ish? Yeah. I don't know if we can hover on that, but roughly 700 million in, yeah, there it is, 697 in UAL change, and so that, so most of those changes are increasing the UAL, but the contributions have been reducing it. But as we mentioned before, the most recent 4 years have looked a lot better than the prior years. Okay, on slide 8, we turn to funded status, and we have some or funded ratio, and we have some comparisons with San José Federated being the yellow diamond. And I would mention that the chart on the right, we had a similar chart back in October, and I think there were some comments about being along the bottom there. Well, that's a survey of California systems, and Bill made a comment at the time that, well, if we when we come back with the national survey, it'll look, you'll have some company, more company, and there will be actually systems that are in worse shape. So it's that California in general, the plans are a little better funded than some of the other states, nationally. But I would say one of the things to point out here, so on the right, you can see that the system's above 60% again, and that hasn't happened since 2021 when there were, exceptional returns. But then before that, you have to go all the way back to 2014, and at that time, the assumptions were much different, right? You had higher discount rates and some of the other assumptions that that have been buttoned down in the years since. So I think it's positive that the system is back over 60% funded.
All right, we'll turn to Jackie for the next couple slides.
So we're just going to look at a couple of projections now. So we've also, in some of these slides, we've got, so in these two graphs, we've got about 10 years historical numbers, which are the lighter bars, and then the darker bars are what's projected going forward. So on the left, the bars represent the liabilities of the plan, and the line, the green line, represents the assets, and then of course the funding ratio at the top, those are the percentages. So the key thing here to look at is that for the liabilities, we have broken down between the tier 1 and tier 2 liabilities. So you can see the darker portion at the bottom of those bars, that's your tier 1 liabilities, and that's projected to decrease. But tier 2 is replacing it, and that's and those bars get bigger. So as your tier 1 gets smaller, so your tier 2 gets bigger. A couple of other things you can see, we're back to the same funding ratio as about 10 years ago. And that's just reflecting how you decreased your contribution, your discount rate, and fix some of the assumptions. So we're back to that good point now, and it's projected to go up. And we're showing to the point where you get to about 100% in about 20 years if all goes well. The slide to the graph to the right, that's your unfunded liability. So you can see over the last 10 years, it's been oscillating. It did increase and it decreased and increased again. But now this year, it is decreasing. It's now below $2 billion again. And one thing that's interesting to look at is that in 2014 versus 2024, you had a much lower UAL, but in those 2 years, you have the same funding ratio. So it just represents how the plan's maturing over time. And then if all goes well, and as the contributions, as we've been mentioning, your contributions are lowering that UAL. As you pay it down, we do expect the UAL to decrease over time. And then towards the end of the period, as I say, if all goes well, you can see that UAL going down to almost zero.
So can I ask that we pause the presentation at this moment? We do have a time certain agenda item 11, and I'd like to take a 5-minute break prior to that. And we'll pick this up as soon as we finish with that. That
Sure.
may take some time.
Absolutely.
Thank you.
Thank you, Mr. Chair.
Recording stopped.
reconvene.
Okay.
My daughter, we were getting picked up by the mic. Okay, so.
Recording in progress.
Okay, so we are taking now item 5E, slightly out of order from our agenda because it is time certain at 11 o'clock. And this is a discussion on a communication that the board has received. It is a letter from 4 retirees concerning their benefits. And these 4 retirees were party to litigation with the plan and with the city, because the plan tendered our defense to the city regarding their retirement benefits. The letter contains probably an abbreviated version of.
Yeah.
Hello?
11:03, 11:05.
Okay, can we mute visitors until we're ready for them? The actual numerical issues are quite complex. I have been informed about this, and we've asked our staff and council to look into this carefully. But there's also an issue at the very end of the letter which states that the letter writer's understanding is that a final decision rests with the board. And I believe we are not so certain that we have that level of authority to make any decisions or accommodations. And so I would certainly welcome the letter writers many are here today or will present online to address that issue. That is, what is their understanding of our authority to make that decision? But first, to introduce the subject further, I guess I'd like to turn to our counsel to give a brief summary of the issues at hand and the litigation that is now concluded.
Thank you, Chair Horowitz. As Chair Horowitz mentioned earlier this year, in February 2024, the Court of Appeals has already resolved this matter against the 4 Federated members who are here today that were plaintiffs in that action. And as Chair Horowitz mentioned, the board and the city were both defendants in that action, and therefore we are bound by the decision of the courts and judgment arising from that litigation. That litigation was entitled Preservation of Benefit Plan Retirees Association versus the City of San Jose and the Board of Administration for the Federated City Plan. And in 2017, after the litigation was filed, the board had tendered its defense of any and all claims related to that action to the city, and the city had agreed to represent the board and hold the board harmless and indemnify the board. The counsel for the board and the city in this litigation was Hanson Bridget, and so I don't know the full details of the litigation, but what I do know is that in looking at their petition and at the court records available, petitioners have alleged the same claim that they're alleging in their letter before the board today, which is that there was a failure to warn about the consequences of their elections or for the selection of 100% service benefits and the service purchases that would impact the calculation of their retirement benefits under the Muni Code and the IRS 415 limit issues. Now, those are legal issues at play in that litigation, and the Court of Appeals ultimately ruled against the members on the grounds that they had failed to meet their burden and establish a claim, and ultimately upheld the trial court's decision to grant judgment in favor of the city and the board, and that was upheld. The bottom line here, from our perspective, the legal perspective, is that the board is bound by the judgment and that we don't have authority to grant the relief sought today, contrary to the court's order.
Okay, thank you. So I guess two issues come to my mind is, does the letter raise issues that were not adjudicated by the court in the court case?
Based on my review of the letter, it's the same cause of action that was alleged in the petition, and that was at paragraph 158 of their initial petition.
And then the second issue is whether or not this board has any authority to enter into any alternative discussion of any way of making the letter writers a different type of consideration than what the court granted.
We're bound by the court's judgment on this,
Okay.
and so unless the board decides that it wants to go against the court's judgment, that's up to the board to decide, obviously, but a fiduciary and general counsel would advise against that.
I see, okay. So what I would like to do procedurally, this is not a hearing per se, this is a response to a communication, at least at this point and at this meeting. So we are going to afford the letter writers the standard commentary period of 3 minutes to address us. And I believe there are 4 signatures on the letter, and I believe all 4 of them are either here or online, have a presentation for us. So we will hear from them, and then we trustees will discuss the issue and what, if anything, we wish to do about it. So hand it over to
Wayne.
yeah,
Okay.
Wayne, okay, please identify yourself first. I only know one of you.
Will do, testing. Okay, real good. Good morning. Thank you for this opportunity. I'm Wayne Tonda. I'm co-author of the letter that is subject of today's meeting. I'd like to highlight that letter, and I've timed this for about 3 minutes. I am very well prepared to speak to the attorney's points about her understanding of the case, but it won't be done in the 3 minutes. If you'd like me to, I'd be very willing to come back. Okay, the highlight of the letter does seem kind of complicated, at least when I read it to my wife, she really thought it was. The co-authors of the letters were the plaintiffs, as already pointed out, in the recently concluded lawsuit regarding the city's reduction of retirement benefits related to IRC Section 415. The linchpin in the case was an ordinance adopted by the city in 1989. The ordinance ordered that the benefits payable to any person who became a member of the Federated City Employees Retirement System prior to January 1st, 1990, shall be subject to the greater of the following limitations. Enter 2. As set forth in Section 415 of the Code, or the accrued benefit of the member without regard to any benefit increases adopted after October 14th, 1987. This provision is commonly referred to as being grandfathered. The implementation of the 1989 ordinance is perplexing. Therefore, each year, the Office of Retirement Services, and I believe it may be Barbara's responsibility to handle that now, sends a letter to each of the affected retirees, a letter explaining their benefits. Most of the retirees receive a letter that affirms that they are grandfathered, and their benefits are adjusted in accordance with the grandfather provision of Section 415, whichever is greater. A handful, however, the 4 of us included, receive a much different letter. Our benefits are limited in accordance with Section 415, period. We are denied the benefits under the grandfather provision, and the city has explained that the ability to purchase service credits and or select the 100% survivor option was not available to plan members prior to 1987. So if you did either, you lose your grandfather status. We respectfully do not agree with this conclusion. And no, it was not adequately or fully addressed in the lawsuit. We were a small portion of really of what the lawsuit was about. To begin with, the purchase of service credits and the selection of the 100% survivorship are benefit options. They are not benefit increases as defined in the ordinance. The retiree pays for the full amount of the option through higher contributions or lower monthly benefits. Moreover, for actual benefit increases, the city complies with the 1989 ordinance by recalculating a retiree's benefits, replacing the benefit increase with what existed prior to 1987. An example is the use of the Bay Area COLA in lieu of a fixed 3% COLA. It seems logical that all actual benefit increases should follow the same process, and it does not. On a personal note,
we may be approaching the three-minute limit.
okay, I'll then conclude. Thank you.
Oh, please.
On a personal note, I worked for the city of San Jose for 31 years and retired in 2002. 12 years after my retirement, I received a letter from the city informing me that my retirement benefits are being reduced due to the city's application of a section of the Internal Revenue Code that, very frankly, I'd never heard of before. I was stunned and shocked, I think like all of my other colleagues, and thought the letter was an April Fool's joke. It was not. I later learned that I had one of the most significant reduction in pension benefits because I lost my grandfather protection when I purchased a few months of service credits at the time of my retirement. This had to be a joke. It was not. What I know is not a joke is my loss in benefits is now approaching $500,000. In summary, I hope, at a minimum, considering our extraordinary set of circumstances, that you reinstate our grandfather status. That's all, not the full benefits. We are available to answer any questions you may have. Thank you so much for your time and attention. I apologize for going over the 3 minutes.
Thank you, Mr. Tanda.
Thank you.
We have a presenter.
Yeah, our second presenter is Randall Turner.
Okay.
He lives in Oregon due to circumstances that he could not.
I understand he has a video presentation.
There you go.
And very good. It is unusual that we would not normally permit a video presentation, but as this is a plan member and a consideration of that, we will allow it at least at this time.
Thank you.
Good morning. My name is Randall Turner, one of the authors of the letter attached to this agenda.
Can we turn the volume up just a bit on that?
I retired from the city. My name is Randall Turner, one of the authors of the letter attached to this agenda item. I retired from the city of San Jose on June 11th, 2011, after 30 years of service. During my retirement prep meetings with the retirement services staff, I made the decision to take advantage of two retirement benefit options. The first was the purchase of 5.6 months of prior service credits, so I could retire before the end of the fiscal year and before my position was eliminated. I also selected the 100% option, which provides my surviving spouse with 100% of my base retirement benefit until her passing. Little did I know that selecting either of these two post-1987 retirement options would lead to the loss of my grandfather status and TAMR protection should these selections result in benefit increases per the city's 1989 Ordinance 23283. I didn't become aware of this until after April of 2014, when I was informed that my retirement earnings were now subject to IRC 415B limits. I believe the purchase of prior service credits and the selection of the 100% option are cost neutral and should not be considered to result in benefit increases and therefore retain members' grandfather status and TAMR protections. For me, the cost I paid for my purchase of prior service credits was $30,760. This figure is the sum of the retirement contributions that I would have paid through payroll deduction, plus what the city would have paid into the retirement fund on my behalf had I worked those 5.6 months. The contributions I paid to the retirement fund through the purchase of prior service credits is exactly what would have been paid into the fund had I worked the 5.6 months. To that end, it is my opinion that this is not an increase in benefits, but is cost neutral, as I funded 100% of the contributions to the retirement fund. The selection of the 100% option requires retirement services actuary to complete a calculation that considers both my age and the age of my wife at the time of my retirement. This information is then used to determine a reduction amount to my base retirement benefit that will result in a projected amount of retirement benefits paid out to me and my surviving spouse That is equal to the amount we would receive had I not chose the 100% option, essentially keeping the overall distribution of retirement benefits equal. My selection of the 100% option resulted in an ongoing reduction to my base retirement benefit of $759 a month. This is not an increase in benefits, but is cost neutral. The current treatment of these two retirement benefit options conflicts, in my mind, with the city's 1989 ordinance 23283. I am requesting the retirement board reinstate my grandfather status as well as my TAMR protections. Thank you.
Okay, thank you. He's not live. This was a recording.
Right.
Okay.
Good morning. My name is Anita Fagan, and at age of 20, I began work full-time for the city of San Jose in February 1977. I retired at the age of 51 in August 2007 with 30 years of service. And throughout those 30 years, city staff would be informed about the excellent retirement benefits that were made, that would be made up for salaries that were sometimes lower than other public service agencies and most definitely lower than the private sector. This was a benefit that would entice loyalty to the city of San Jose for a long time, 30-year service. When I attended pre-planning classes for retirement starting in the 25th year of my employment, all I heard was I could retire at 30 years of service at any age in order to get the maximum 75% retirement. I never heard a thing about grandfathering implications, nor did I hear anything about loss of benefits based on tax implications of the Internal Revenue Code 415B. When my husband and I went to my appointment in retirement services to sign the paperwork, we were presented with 3 options relating to potential survivorship should I die. 1, I could get my full 75% for life and my survivor would get nothing. 2, I would take a retirement amount reduced from the full 75% and my survivor would get 50%. Or 3, I would take an even lower retirement reduced from the 75%, and that amount would remain for my survivor. As I had a younger child still in college, and I have a fatalistic view that any of us could get hit by a truck at any time, I believed that my salary was essential for my husband's maintenance of our lifestyle. My salary at this time was higher than my husband's because he had already retired at a reduced income. And therefore, it was valuable to take that 100% survivorship option. So we did. At no time was grandfathering or the loss of such ever mentioned. And in fact, I had no awareness of that term until my retirement was reduced even further when I got a letter in April 2014, several years after my retirement, about the 415 benefit reductions. And in my case, because I retired at age 51, the 415 caps are very much reduced because they calculate your retirement age at 65 and reverse back. It was about a 50% cut in the IRC 415 caps. 2 years after I retired, my husband died. The protection offered by the 100% continuation of survivorship benefits is no longer needed. I still receive the lower amount, which now is even lower because of 415 benefits. I'm here to ask that, like the 3 others here, our retirement benefits with grandfathering be calculated so that we can be compensated the amount which is most beneficial, keeping in mind that my contributions for my 30 years of service was for a full 75% retirement, and I've never received that. Thank you.
Thank you. Mr. Castellano.
Good morning.
Good morning.
Chair Horowitz and members of the Federated Board.
My name is Jay Castellano, one of the authors of the letter attached to this agenda item. I am also a former member of the Federated Board, and I address you with the empathy and respect for your fiduciary role in administering the plan. Similar to the others, I worked for the city for over 30 years and exercised the option to purchase 4 years of service credits that cost $150,000 back in the early 90s. I retired in June of 2011 after 32 years, and I received my full pension for 3 years until 2014, when I received the same letter that Wayne and Anita mentioned, explained that my pension would be reduced due to Section 415B. And with the others, it was later determined that my purchase of service credits was a benefit increase that disqualified me from grandfather status. So here are my challenges with my current situation. One is that the price for my purchase of service credits, as Randy mentioned, was an actually determined amount, and it represented both my share and the city's share of retirement contributions. I fully paid for those service credits myself. Actually, this was not a net cost to the city or the plan. In that sense, we believe the purchase of service credits is exercising a plan option for which we paid. It's different from the other benefits that you're familiar with, the single highest year and the automatic 3% COLAs, because those did require increases in employer-employee contribution, whereas purchase service credits and the 100% survivor benefits were paid for by us. Two, in the 1990s, when I paid the $150,000 for the service credits, despite the 1989 ordinance, I was never forewarned about the potential effects of retiring before age 62. And three, again in 2011, when my wife and I went through the retirement counseling process, we were not informed at that time about my option to work more years to mitigate the impacts of 415B, nor was I given the option to return the service credit and work more years to avoid the impacts of TAMRA. A prior version of this board gave that option to former city manager Dave Sykes, as attached to the letter that we sent you. But that was not an option that any of us had when we retired. So as the final speaker today, I'm going to take a step back and share with you a perspective that each of us worked for the city for at least 30 years, and for those 30 years plus a number of years up until 2014. So in Wayne's case, as he mentioned, 12 years after retirement, 42 years. In my case, it was 35. We and all other Federated City employees were told by the city and by ORS that we would receive a pension of 2.5% per year or 75% after 30 years. And we all paid, employees and the city contributed through contribution rates to fund that benefit. There was a 1989 ordinance on 415B, but no one was advised about it by Employee Relations, Human Resources, ORS. All of that is inarguable and documented in the union contracts and in the benefits handbooks that were in print at that time. All of that changed in 2014 when our pensions were reduced. In Wayne's case, maybe $40,000 a year. I'm in the $25,000 a year range. These were not reductions that we planned for. This retirement plan, your plan, includes assets derived by our contributions using rates that during our working years were never discounted in anticipation of our reduced pensions. We paid for a full 75% benefit that we will never receive, whether due to 415B or the loss of grandfather status, and we were never forewarned about the reductions while we still had choices to make about how to mitigate them. All of that is simply wrong. So with that perspective, we hope that the board will consider today's request regarding grandfather status with any discretion deemed appropriate by your CEO and by your fiduciary council. Thank you very much for this opportunity to address you and to share our perspective on the issue.
Okay, thank you. I'm going to turn to the trustees. I think this is certainly for those of us who don't work for the city enormously complex. Maybe for those of you who do work and are retired may have a bit more insight. It seems there are a couple of issues. which have been raised, that is the counseling that they received at the time they retired, which led them to make the choices they made. Another issue is whether or not any of these issues were or were not addressed in the lengthy litigation that they had with the city. And then finally, what leeway, if any, does the board now have to accommodate, if we so wished, any of these situations? So I don't know if anything to add, or Council Chen, if or anything. Well, I just wanted to ask Council Chen, is anything that was raised here in comment today outside the scope of the legal case that was brought and decided?
Based on my review of their initial petition that was filed in July 3rd, 2017, all of the same allegations are, I'm sorry, all the same comments today are the same as the allegations stated in their second count. And so it is encompassed in the prior litigation, and to the extent that a judgment was rendered in that case, that judgment on that count as well is binding on this board.
Okay. Trustee Linder?
I met with 3 of the 4 who are speaking today, and it appears to me that there was lack of adequate information at the time of their retirement. Having retired myself short of 13 years, I don't have the 30-year counseling and options and whatever. And so I'm encouraging to bring this to the board to see what our options might be. I think there is some injustice here, and I understand there is a court decision, and I was just curious if the board decided to do something different than the court said, what would that do or mean or whatever?
Well, we could be held in contempt of court to a certain extent that we violate the terms of the court's order and judgment. I will also note that we tendered our defense to the city on this, and so the city and the boards were both equally aligned in litigating the case as defendants in this matter. And because we have already tendered our defense in that case regarding all claims and related claims from that, it would be my recommendation, if the board seeks to seek further review of these matters, that we send it back to the same law firm that represented us in that case to take a look.
To send it back to the law firm, is what you're saying?
Right. So, for example, if a further challenge is made to the board's decision not to take action that's being requested, then any sort of further action against the board's decision would be tendered back to that law firm. What I don't want to do is take an inconsistent position that we've taken in the litigation here, because we're bound by the judgment. The court, I will say that the court did looking at the Court of Appeals' decision, it did look at a number of things. It did look at the ordinance itself and interpreted the ordinance. It did look at the IRC, the Internal Revenue Code, and the 415 limit there, and interpreted that and compared it to what the ordinance means. And so, again, and another thing to note is that some of the comments here are construction of the ordinance itself, which is a legal question,
Right.
and that has been discussed and determined by the court.
Yeah, the part that bothers me is not informing until they got a letter informing, many years after the decisions were discussed. And so I don't know whether there's any way that part of the issue can be relooked at.
It would be
The
subject
lack of
to
information.
Right, so it's the same claim, but they're seeking a different relief before the board, right? So they sought one sort of relief in the litigation, they're seeking a different relief here before the board as an alternative basis of relief. It's the same claim, so under res judicata and collateral estoppel, we would be subject to the same court order.
Got it.
Questions from any other trustees? I mean, my sense of it is that I wish they had been fully informed at the time of their retirement, and that would have informed perhaps better decisions. it seems from everything I've heard that that issue has been overseen by the courts and decided upon. We don't need to make any decision here today at this time. So I would leave the door open and challenge the letter writers to provide us with some justification, if any exists, where this Board of Trustees could make a judgment different.
Right.
From our legal counsel, we're hearing that's not the case. Your letter claims that we do have that power. What is the basis of that claim, where we could even consider getting into the, frankly, getting into the weeds of these judgments? So I'm not asking that you answer that now, but I leave that as a challenge if you wish to come back or wish to have another communication, another letter with the board that suggests on what basis we could.
We have that authority.
We have that authority. Thank you.
Again, Wayne Tonda, I think
Yes.
it would be our best action if we didn't send it back in writing, what our points are, because you need to go through the court case to determine why we lost. We lost
Well-
because we didn't submit something on time.
Mhm.
We lost because we weren't able to provide evidence at the point that the court requested it. There are a number of legal things that occurred that did lose the court case. At time, we never got to a trial. We lost all on precedents of court cases, et cetera. What I would ask the attorney's office to do is to read, I think we have thousands of pages, but to read actually the reasons we lost on certain points. On this one that we're bringing to you now, this is not at the heart of our court case. The heart of the court case was the establishment of a supplemental plan that affects everybody who was impacted, about 24 people rather than 4. And on the supplemental plan, the rationale on that plan, the justification was the 1989 ordinance. It comes back to that. So we were told you got to be consistent with the 89 ordinance, and that's when we found out that to be consistent with the 89 ordinance, you were determined to be ineligible to be grandfathered if you took either one of 2 options, which was our point. We're focusing in on a very specific aspect of our court case. And if you go over the court case, you'll find that we lost on the grandfathering, on technicalities, on not having data at a certain time, and on the assertion, if you can believe this, by the city's attorney, that we didn't lose grandfathering, that we just don't understand it.
With respect, I don't think we are empowered to revisit the entire court case.
Oh, no, we're not asking that.
And so what I'm asking is, what is the basis for our authority to grant any type of relief, which would be outside the courts?
And on that, I just asked, probably the attorney's already thoroughly reviewed this, but the board has taken action in the past, most notably about 7 years, in 2015, whatever that is, 8 or 9 years ago, on almost exactly the same issue. And a report is written by, I think, Barbara's predecessor, speaking to that and speaking about why it would be okay for this board to take a very unique action, and that is to address the purchase of service agreements by 2 former city managers. We're not city managers, maybe we don't have the same status, I don't know. But the board has acted on that, and the authority is included in that report.
Okay.
Okay.
So I guess we need to review that experience, and
Well, I'm not certain if that necessarily is directly on point. We do have a court order here, which makes it a little different from any prior situations. If there was another court order binding the boards to the resolution of that controversy, to that letter, then yes, we would take a look at it. But here we are in a very specific circumstance where the court has already resolved the controversy and we're bound by that resolution.
I see. I understand, but this is the first I'm hearing about this prior example. Let's not call it a precedent. So I think it behooves us to at least examine that and understand the full context of how that decision was made at that time.
Sure, to the extent that it's useful.
You will advise us. Okay.
But if
we
we were to do that,
Mhm.
is that a financial obligation on the plan to do that, pay for that?
I don't think we're at that stage yet of understanding that. I'm just trying to see if there was even a precedent
No,
that would
but
allow us.
if we're directing our general counsel
Mhm.
to do an in-depth analysis, if that's what I heard, then to me, that's a financial commitment on the plan.
Mhm. Yeah, I'm
And
not.
is that what you're requesting?
Yeah, I'm not sure I would use the word in-depth. I would just identify it. I assume there is some existing paperwork that describes that situation.
So,
In the-
Maytag, can you answer on this?
Again, to the extent there is a similar court order, again, what we're looking at is the procedural posture of that matter and this matter, and to see if they are similar. To the extent they are similar, then yes, we should take a further look. But to the extent they're not similar, meaning like they didn't have a court order, we are bound by a court order, the circumstances are
Then
just
it's a
different.
different situation.
Yeah.
Okay. So I'm just suggesting that let's identify what that case is and understand it, not doing some type of deep dive into all the specifics of that case. Was that a case where the Board of Trustees took individual action in addition to or contrary to a court order? So is there a precedent for us doing that in the past?
And again, if we were, that's valid. If we were to do that, I mean, since there is a court order, since the city took over, since we are not even part of that, then we're opening ourselves to a possible legal issue with the city and with the courts if we were to go against. So we need to be cognitive of that.
Yeah.
And I kind of have an issue with that, you know?
I'm
So,
sensing that.
Yeah.
Well, I think our legal counsel would advise us the degree to which that is a parallel or non-parallel situation, what our liabilities would be if we were to take up this issue at some future time based on that. And of course, it doesn't mean we are not prejudging and actually making any determination if we were to take it
And the
up.
other thing I would say is there are probably lots of other cases where certain employees who are not at this
We have to very
issue
much be cognizant of creating
of
precedents.
what we're opening up
Yeah.
because they were not educated by
Fully
the
informed.
city in OER or retirement services. So that does open up this big window.
So I'll ask the question, and maybe you're about to address it. Even by asking the question, are we opening a precedent or creating liabilities for the board or for ORS?
I think looking into something doesn't create a liability.
Okay.
Acting on something contrary to a court order does create liability. Another thing I want to mention is that it's not just the court judgment in this case that binds the board, but it's also the IRS rules that bind the board vis-a-vis the ordinances. And so that's a question for tax counsel, and so I defer to them on that question. So it's a two-step, there's two barriers here.
Okay.
So the 2015 letter that was attached to this, where they made an arrangement with the former city manager, is not particularly relevant to this particular situation?
That was before a court order was issued, and also
Yeah.
we would have to look exactly what the circumstances are for that individual. For example, was this person in active status, retired status, or what other factual circumstances? Again, we would have to see if there's a parallel in play.
Okay.
What is the date of the court order?
Okay, online comment?
1 second, trustee Avasi had asked a question, the
Oh,
date of the
I'm
court
sorry, I
order.
didn't hear that.
Yes, so the Court of Appeals issued its opinion in an unpublished opinion on February 28th, 2024.
Okay. The online commenter?
Hello, are you referring to me?
I believe so, Mr. Moore.
I think you're it.
Thank you. Again, thank you to the board, and I would hope that the board would go ahead with the recent court decision. And as a stakeholder, not only being a taxpayer, but a beneficiary, that you do not expend more board funds on researching this matter. I think it's already been adjudicated, as your legal counsel has indicated. So again, I want to thank the board for that. And it's interesting to note that the petitioners on this letter that you received are highly compensated individuals. And I would say that probably the average retiree makes less than $50,000 a year. So I think you need to take that into account, and hopefully we'll get a better funding status as we go forward. Thank you again.
Okay, thank you. Is it council's view that the direction to, quote, look into this, is this something that requires a motion and a second and a vote by the board?
So the way it's agendized today is just for discussion, so there is no ability to take action under the Brown Act. However, if the board seeks to take action at a further date on something, they could agendize it, but for this particular request, you can direct staff to look into the matter.
Okay, so that's
without a motion.
So that's within my jurisdiction to direct staff
That's correct.
to look into it. Okay. So I wish the staff to look into this prior example that Mr. Tanda has raised, and with a view to understanding it further and if it parallels our current situation.
Could I just ask a question of your attorney? 'Cause
You know, we want to keep this within the Brown Act limits of 3 minutes, and I'm not sure it's appropriate to have you directly question our attorney. So.
Well, she said something that we've never heard of before, and that is the court says that you can't take any action no matter what information becomes available. I don't think that's the case. I think the court says the city is not obliged to do anything requested by us. It doesn't mean you cannot. And that's a layman's perspective. That's what I understood was occurring.
I can briefly respond to that.
Please.
So our public meetings here today are governed by the Brown Act, which is the California law regarding the conduct of public meetings for legislative bodies, such as this one here today. The Brown Act requires that a matter be agendized for action within 72 hours and posting of that action, so the public is aware that action is being taken and what the request for action is being made. If you look at the agenda for this agenda item today, it's only for discussion only. And so without it properly being agendized for action, it's only for discussion for today. So it's under statute, not the court.
We'll put it in writing.
Okay, I think we may have exhausted this particular topic. I appreciate you bringing it forward. I know it's a challenging issue. We are going to look a little bit further to see what leeway and what jurisdiction we may have. It sounds like it's quite limited, but I want to understand that further. And, you know, you will have a chance to communicate with the board further in the future, and we may have that agendized at that time. So appreciate you being here. And if there are any other questions from trustees, comments?
So you referred it to Mr. Flynn?
Yes.
Okay.
Thank you.
Thank you.
Thank you for being here.
I'm sorry, was that a? Oh, we have another comment from the same speaker? Well, I think we've already had 3 minutes from that particular. Okay, very good.
Thank you.
Thank you all. And I thought I'd never say these words, but now on to something lighter. We can hear from our actuaries. So we were in the midst of item 5D1.
Yes, we can get back to the exciting topic of the actuarial projections for the plan. So this is just where we left off. Just to reiterate a bit, you know, we have the historical, the 10 years historical in there, but the 20-year projection, the plan is looking great. It's projected to get to 100% funded and zero unfunded liability. If all goes well, meaning the demographic assumptions line up and investment returns are as expected. Obviously, they differ, but net we would hope they would all come out together. What we've got here is just a schedule of the Tier 1 amortization payments. So every year when there's a gain loss, whether it be on assumptions, benefit changes, or experience gains and losses, an amortization base is created for that. And then it's amortized over a period of time. So what this graph shows here is each amortization base. So if there's a base, it's got for example, if it's an assumption base, it's a purple portion of the bar. If it's an experience, it's a yellow one. So if we're looking at the last 5 years, you can see it actually. You can see your contributions, the amortization payments increasing a bit over time, and that's as they increase with payroll, an expected increase in payroll. And then you're going to have some drops. The line is negative, so you can see a drop there in 2041 as certain bases get paid off. Okay, so if we're looking at the last 5 years, right now, as of 2026, the fiscal year ending 2026, you can see that your net payment is about the net payment is 11 million, and I think and about 8 million of that came from your 2020, the base that was created in 2020, and I think that was for assumptions and investment losses. So you can see a good chunk of it is coming from 2020. Without that, the net would be closer to 3 million. If we look at the all, so not just the last 5 years, but every base that's currently in play right now, you can see there's a big red bar there, and that's your 2019 UAL base, which was the initial base when it was all reset. And that's a big base, and it accounts for a very big portion of the current payment. Because your current payment's about 180 million, and only 11 million of that comes from the last 5 years, and 68 million of that is from that 2009 UAL base. And you can see that red bar is kind of increasing a little bit over time with the projected payroll increases. But then once it's paid off in fiscal year ending 2041, you can see that huge drop in your UAL payment, your city amortization payment. So that's just something to look forward to in the future. I know our plan has some board members that are eager to be around at that point to see what actually happens when when you have that huge drop.
From your lips to God's ears, yeah.
So that's just something key for that. So are there any questions regarding this slide?
No?
Oh, sorry?
No, go ahead.
Okay. This slide is looking at your projected contribution rates on the left and the contributions as a dollar amount on the right. And again, we have 10 years of history and about 20 years of projected numbers. And what we've got here is in each graph, there's a blue line, which is what we projected with last year's valuation. So I think what's key to look at is we've seen the same pattern of movement. The pattern isn't changing, but you're seeing slight shifts with the results right now. So as in comparison to your 2023 projections on the left, with your good returns, you have your contribution rates are actually lower than what we projected they would be with last year's valuation. But on the right, you can see that the dollar amount of the contributions is slightly higher than the projected. And what that's coming from is the large increases in pay. So because you're paying the contribution as a percentage of your payroll, that's why you're seeing that, you're not seeing that drop in the dollar contribution amount like you are in the actual rate. And with
Okay.
that, I'll hand it back to Bill.
So those are the baseline projections, and when we present the valuation, we also want to talk a little bit about the risks associated with the future and where things go. Because those projections, everything is going exactly as we assumed. And one of the dynamics we want to talk about is the maturity of pension plans. And a mature pension plan, unlike you may think of a mature person as being very even-keeled and able to handle adversity and all of those sorts of things, a mature pension plan is the exact opposite. They're very prickly and very sensitive to any changes, both positive and negative. So it goes both directions. And so understanding when your plan is becoming more mature and how mature it is compared to others will give you a sense of how sensitive it is to various risks. We start this by looking at the membership trends, and we showed this with the preliminary. This is showing right now just the active members with the tier 1 in dark blue and the tier 2 in the teal. And you saw that, you can see that in the middle years there, we had a real decline in the Great Recession in the active membership, and it has grown since. That sort of growth helps limit the maturity of the pension plan, but that decline really increases the maturity. And so what we're looking at in terms of membership trends to assess maturity is just the comparison of the active members to the inactive members, both retirees who are receiving benefits and people who are no longer working and entitled to future benefits. And so those are all the gold and the green bars that have been increasing much more rapidly than the active population until the last couple years. And so we calculate a support ratio as the division of those. And you can see that support ratio really drive up with the Great Recession. Then it kind of leveled off. And then as we've seen that growth in the active population in the last couple of years, it's started to come down a little bit for your plan. The reason that we look at this is whenever there's a gain or loss, it's on the entire plan, but you're paying for that gain or loss over the active membership as a contribution. So our contributions we look at as a % of payroll, and so that impact on the % of payroll for the contribution is larger the more retirees you have, essentially, for any gain or loss.
Well, so the tier 2 are growing. Tier 1 is, but then, you know, if you add them up, you almost have to add them up, right? Because you have maybe 6,000 tier 1 overall. You know, with the
right.
in-pay
So
versus the active, because they all have to.
So it's a very
go there.
And we'll come into some of this looking at the impacts on tier 1 versus tier 2. Right now, I'm kind of looking at it as the city as a whole, and payroll is kind of a rough proxy for what's happening with the city's revenues and their ability to pay for additional pension costs, but that's just a very rough proxy.
And for next year, depending on what materializes from what Councilmember Davis was telling us, most likely, the way that works is if it is a reduction in force, it's tier 2 who will go, not tier 1, because they don't have the seniority that, you know.
Yeah,
That's
but
just 1
based
year.
on.
That's 1 year.
Based on what we heard, 1 year, we may see a slight reversal in these latest trends.
Right,
So we'll have to keep an eye
right.
on that. The two measures of maturity that really get to the financial impact, we call the asset leverage ratio and the liability leverage ratio. The asset leverage ratio is just the assets of the plan divided by the payroll.
Oh, okay.
And so the larger your plan gets, the more assets it has, the larger that number's gonna be. But that gives you an indication of your sensitivity to investment returns. And so let me run through an example and then I'll explain that on the chart. If you had a 10% investment loss compared to our assumption, so we're assuming 6 5/8, that'd mean you had a -3 3/8 return, 10%. If your asset to payroll ratio is 5, that loss represents 50% of your payroll. 10 times 5 is 50% of your payroll. We're gonna set up an amortization over your payroll to pay that off, right? So we've gotta pay off 50% of payroll over whatever period we choose. We use 20 years, but
Right.
it could be over whatever period. Now, if you had a plan that instead of a leverage ratio of 5, it was 10, that same 10% loss would be 100% of payroll. And so whatever amortization we set up would have to be twice as big for that plan as a percent of pay than it would for the plan with 5. And so that's what we mean by the sensitivity. It's the sensitivity for that same investment loss and how it translates into your contribution rate and what percent of pay you have to put in to pay it off.
And that's sensitive because of the aging of the in-pay versus the
Yeah,
assets?
so that's partly why we keep showing the liabilities broken out between in-pay and active, because that's a measure of how mature you are. It's all of those factors kind of go together. Now, on the chart on the left, we're showing the historical asset leverage ratios. And the bars are the range in the National Public Plan database. The gold diamond is the Federated plan, and the black triangle is the combination of the Federated and Police and Fire plan.
Oh.
So this is a much bigger deal for the Police and Fire plan, but since you're part of the same city, we want you to be aware of it. But if you look at where the gold diamond is, it's above average, but it's within the range that we typically see for a public plan. When we combine it with the police and fire, you're at the high range. So the city of San Jose as a whole is at the high range. And if you were just to look at the police and fire plan, they're kind of off the chart.
So just to clarify, you're not suggesting there's something that we can do at Federated to accommodate this higher citywide leverage ratio?
Right. So there's a couple things here. First, this isn't something you did or
Okay.
anything. This is a characteristic of the plan, like being short or tall or,
Okay.
whatever. It's based on the experience of the plan and it's where you are. So it's a characteristic. And it's something to be aware of. But no, we're not suggesting any specific actions for Federated in particular.
Okay.
The liability leverage ratio is the same concept, but we're using the actuarial liability instead of assets. So that measures where your assets will be if you're 100% funded. So that will make you more sensitive to investment risk. It also affects your sensitivity to assumption changes and salary increases and other things like that are measured by that liability ratio. But the same concepts.
Is that
I do
because-
think.
Is that because police and fire are more, I guess, aged or matured? They're
Right, they're more, it's typical for a public safety plan to be more mature.
because they retire earlier?
Yes.
Yeah.
But they also have a higher funded status.
But they also have a higher funded status, which makes their asset leverage ratio higher than yours. So there are a number of dynamics. It's just to be aware of this sensitivity. You're more in the mainstream right now with the asset leverage ratio, but for the city, police and fire puts it up to a much higher level, which means, if we have great investment returns, there's some substantial benefits to the city. If we have poor investment returns, it's much more difficult. So it's just going to be much more sensitive for the city. There will be more variation than you would see, for example, with other cities in California.
Okay.
But again, for the federated plan, you're well within the range of what we'd see as normal for public plans. I don't want to spend too much time on this slide because there's a lot of numbers in this presentation. I want to get to the other ones. The chart on the right is just showing the sensitivity to a change in the discount rate and what that would do to contributions. The chart, that's the chart on the left. The chart on the right is one measure of looking at the sensitivity of investment returns. And because the investment returns this year do not affect contributions until 2027. There's a little projection there to show you that sensitivity. But we'll get some other looks here when we look at the projections.
And that was based on a 1-year negative 20% investment return?
Yes.
So that's a fairly severe
Very severe.
impact. Okay. And it looked like the actual result was not all that.
Yeah, okay, let me
You want to
at least
go
make
back to
this
that one?
comment. Yes, the actual result in the first year in the total contribution is relatively small. That's because we smooth assets over 5 years. So that's going to continue going up. The immediate impact you see is in that interest on the UAL bar. And so that went up over 11% of payroll. So that's the immediate impact. The other thing I would point out here is the normal cost and member contributions are not affected by the investment return. So they do not really change on the right-hand side, a little bit because of the Tier 2 member contributions. On the left-hand side, if you change the discount rate, it very much affects the member contributions as well as the city. But to really look at your sensitivity, we created a couple investment return scenarios. These are not intended to be realistic scenarios, but to illustrate the sensitivity to investment returns. We used Makita's capital market assumptions, and for the 1 year, we looked at the 5th and 95th percentile. So those are way out there returns. So 90% of returns would fall between those two. And we created a 1-year shock scenario, both negative and positive. So it just happens for 1 year, and then you go back to your 6 and 5/8. So you can see how the contributions and everything are affected by that 1 year. And then to give you a little bit longer look, we looked at what we call a 5-year moderate, so looking at the 25th and 75th percentile. returns, but having that return go over a 5-year period, but then return to the 6.625 again. So it's really to look at how the system reacts to those kind of inputs, and that 5-year moderate range should cover about half of the scenarios. So here, I want to preface this by saying, by clarifying something. You may have noticed we're using some new software to make our charts be interactive. The printed version of this, we're still working on, and there are some call-outs on the printed version that were inadvertent. It's just wherever the cursor was when they converted it to a PDF, created a call-out. So there's nothing significant meant by the particular call-outs in the printed version. Oops, let me.
I like this. Just to let you know.
Yeah. So we'll work on that and get rid of these the extra pieces in the printed version. On the left-hand chart here, we split up the actuarial liability between the assets and the unfunded liability being red, and then the blue line is our baseline projection. And on the right-hand side, the blue line again is the baseline projection, and you have the member contribution and the city contribution. So everything lines up with the blue line. So if we do the 1-year negative shock, so that was the minus 12% return, you can see what happens here. That the assets go down, the UAL goes up, contributions go up, and so we're putting quite a bit more money into the plan, and at the end of the 20-year period, we're not at 100%, but we've gotten back pretty close, right? If we do the 1-year shock positive, now we're putting in a lot less. We're getting to 100% funded much earlier, and we're actually developing a surplus with our current contribution policy. So the other thing I should say about these scenarios is we're assuming we make no changes in anything along the way. And in both cases, we always revisit the contribution policy and what we should be doing. You revisit your investment policies. So this just ignores any of those changes and just locks in the current policies.
And the smoothing is still the same?
Yes, we have the 5-year smoothing is in here. So if you do that 5-year moderate, you're still getting positive returns, just not what we expected. And so you can see the assets continue to grow, but much slower than what we anticipated. And it takes us longer to build up the higher contributions than it did in the 1-year shock. But ultimately, we do. And after 20 years, you end up in a very similar position. In the 5-year moderate positive, not too surprising, you do, it looks very similar in that we're reaching full funding around 2034, and then building a surplus, and contributions drop down more gradually.
So,
Prabhu? Yes.
So if I'm looking at I'm comparing the 1-year negative, I'm not worried about the positive, if we do that, fantastic. 1-year negative versus 5-year moderate negative, it looks like both of those are fairly similar in terms of the end result of when we eliminate. Am I mis-eyeballing that?
Yes.
I am.
The pattern, so a lot of that is being driven by your amortization policy, right? They are similar ultimate impacts, but it's also how you're
We take a different path to
amortizing
get
and
there, but
paying for it.
Ultimately, the contributions will be significantly higher.
So in addition to looking at the scenarios, we do the stochastic projections. We look at 10,000 different projections of investment returns and look at how, look at all the different outcomes. The range of the bars goes from the 5th percentile to the 95th percentile. The dark bars are the middle 50%. I think in addition to kind of the obvious spread that you get in potential contributions here, it gets pretty wide, right? In 2034, it could be 10% at the very optimistic end, up to above 60% of pay at the pessimistic end. But I think the other thing to keep in mind here and look at, because of the amortizations we've set up and the time that's elapsed on those, is there is a trend downward as a percentage of pay. And so that's largely because we've taken those hits of the large amortization basis that Jackie was showing you. And so we're at the point where we're really starting to make progress on the unfunded liability. We've got the amortization payments growing at less than what we expect payroll to grow at. And so there is some downward pressure on it as a contribution rate as a percentage of pay. Now, just very quickly here on the left side, we're showing the same thing, but as a dollar amount and only looking at tier 1 contributions, and the right side, tier 2 contributions. We put them on the same scale so that you could see how much smaller the variation is in tier 2 than tier 1. So the real sensitivity is on the tier 1 side. There's similar sensitivity on the UAL, and then we've added some probability of achieving different funding ratios, and you know, we're above 60% now, 80% is coming into view, 100% still a little ways off, but it is possible, starting to show itself in a few years as a possibility. Over the long haul, you could develop, if we took no actions, you could develop a significant surplus. If you ever get close to that, we would certainly be looking at potential changes. There appears, whenever you look at these charts, there appears to be kind of a cap on what the UAL can be or a floor on what the funded status could be. That is strictly because when you have bad experience, we are raising contributions. And so we're assuming the city makes those higher contributions, and that effectively puts a floor or a cap on these numbers. So it's not that things can't get worse than that. It's that if all the assumptions, if the city makes all the contributions under the current policy, then it can't get worse. So that's it for the valuation. We'll take any questions. And as I mentioned earlier, there is the report. I can answer questions on that report. We haven't really used it for a few years, but we have the interactive model if you have something specific you wanted us to look at.
Thank you very much. I always appreciate the sensitivity analysis. Are there any questions from trustees?
I have a question, but it's probably not for you to answer. It's probably more about, it feels to me like some of what I've heard is that it's likely that our returns have been higher than normal and that we may go back to lower returns in the next 10 years. And do you have any sense about whether the higher returns or the lower returns may be more likely? Or is that something we really need to look to Makita when we do our asset allocations?
So I'm an actuary.
I know.
My job is to plan for multiple scenarios. And so to look at those possibilities, that's why we're bringing the sensitivity.
Right.
I am not.
But I think if you go back to the 5 years of substandard returns, that kind of parallels, I think,
Yeah.
the scenario
Yeah.
you're speaking of.
Yeah.
And, you know, there's the time to eliminate the UAL is longer, but we do get there in the end.
Well, you keep on pushing it out 20 years.
Yeah, in
and
the
we
long
hold
run, we're all
everything
dead, but,
constant,
yeah.
So, no offense, but 5 years from now, you're gonna look at that same trend.
Yeah.
Right?
Yes.
Deb's shaking her head, yes.
Yeah.
So,
Although it looks a lot better now than it did 8 years ago.
yes.
Yeah, I was gonna say, if we go back
Yeah.
even 5 years, we're looking much better now.
Yeah.
So it doesn't mean in 5 years we'll be looking at the same picture.
Yeah.
We'll look at a different picture, but,
It depends.
And no one knows the future, but 5 years of bad news, that's a whole lot of bad news stacked on
That's a
top
lot
of
of
each
bad
other.
news.
So,
So,
let's hope it doesn't happen.
from an investment side, you know, it's asset allocation, it's Bapu and what he does with his staff and
We've
the
placed an awful
excellent
lot
results.
on your shoulders,
And
Prabhu.
we maintain the staff that we have because they want to work for the city and do this for us.
They have no
It's
other
what the
options.
market does. I mean, there's 20 different ways. But I do think overall, probably the biggest point is really just as the tier one ease out of the system and the tier two become a bigger piece, the obligation will get. I mean, at least for Federated, right?
yeah, I think, you know, if we go back to some of the charts showing the changes in UAL over the last 10 years,
Yeah.
I feel like we have made significant changes in our assumptions and how we handle the system. We've changed the contribution policy, all of that. That process was very, very painful, and we had to do it in steps to manage it. But we're at the point now where we have those policies in place. We've incurred the hard stuff. We still have to deal with the experience going forward, but it does feel to me like, you know, we've done the hard stuff, but it takes a long time to turn something like a pension plan around. So it's not going to be tomorrow or next year that we're just celebrating that we got to 100% and it all looks good. But the path we're on, to me, feels much better than it has for years.
Which is good.
Yeah.
Yeah.
Absolutely. Better than the alternative.
Yeah. Comment. There's a comment.
Was there a comment online? If for any other comments from trustees? Let's go to the online comment, 3 minutes.
Is that me again?
Mr. Imamura, please go ahead.
Yes, Mr. Chair, thank you. This question's maybe to Bill. So just for clarification, the fund is currently sitting at 61% funding, is that correct?
That's correct.
And you indicated you projected 100% funding by 2034?
No, that was in one of the positive scenarios. Our,
Yeah, that's what
I think our baseline is.
our baseline, it's about 2040 or 2041.
Okay, that's what I was kind of wondering.
In 16 short years.
So, yeah, essentially, basically, everyone on the board is going to be gone at that time. I may be gone at that time, but unfortunately, as I see the agendas and see the number of people who are on the deceased list is now approaching about the same amount as those retiring. What I'm concerned about is, and those first-year employees, you know, no sign of any disrespect, but, you know, really all they care about is they're getting their check every month. I don't think they have a clue how this retirement fund is being funded and the funding ratio or whatever. And I'm hoping, well, maybe there is no hope, but maybe people will start going on Amazon and purchasing a backbone, and maybe, you know, coming to the board and speaking and finding out what's going on. So would you say, Mr. Chair, if this was a private board and you were, you know, the chair of a corporation, would you say that the board would probably, you know, replace itself because of the dismal returns that we've been having over the last 4 or 5 years? No response?
I would,
Yeah, see, that's the problem with this type of interaction is
Mhm.
I'm speaking to basically the wall, and everyone sits there stoically, and they have no responsibility,
well, we
no
do,
feeling of it.
if you
Integrity.
permit me, I will
So we can't
respond,
have
even
any
though,
fun. We can't have any communication.
yeah. I will respond, even though this is a comment period, not a Q&A. We do all, as trustees, have a fiduciary duty to safeguard these assets and to reduce the unfunded liability and to increase the funded status. We actually have had returns that have placed us in the top 5 percentile over the top decile over the last 5 years. So we've done an enormous work turning this around, and you can see that by the upward sloping trend of these charts. So I would just say we take this enormously seriously. We are focused, even if some of the members, as you imply, are not as focused, and that's, people have day jobs, it's perfectly understandable. But we are focused. This is my full-time focus. I'm retired, and this is the only thing I do. And we are working diligently to improve the returns and to make sure that we do achieve that 100% funded status by 2040. And I believe, based on some very realistic, very conservative assumptions, we will and can achieve that. So hopefully you can take some measure of assurance in that. Okay. Any other trustee questions or comments on this agenda item, which is 5D? Any other public comment? If not,
Well, I don't appreciate being muted.
well, we do, I'm sorry, comments are limited to 3 minutes per agenda item. I think you've made your point, and I hope I've addressed it, at least to some degree. This says discussion and action, so we need to accept the report. So if anyone would like to make a motion to accept?
So moved,
We
Mr.
have
Chair.
a motion from trustee Linder. Do we have a second?
I second.
We have a second from trustee Avasti. If there's no further discussion, we will have a roll call vote. Trustee Faulkner?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Linder?
Aye.
Trustee Jennings?
Aye.
And the chair votes aye. Report is accepted.
And just for the record, is trustee Chandra still on the line?
I believe he is no longer here.
Okay, thank you.
So we've covered item 5E, which leads us to item 5F. Speaking of Mr. Chandra. Discussion and action on election of the vice chair. At the last meeting, we nominated trustee Chandra to that position. Let me inquire of our council, is it possible for any other trustees to be nominated at this late date?
No.
Okay. We have one candidate, and so we will have an election on whether or not we approve that candidate. Is there any questions or discussion? If not, then we will have a roll call vote. Trustee Faulkner, trustee Chandra as vice chair, yea or nay?
Yay, aye.
And trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Jennings?
Aye.
Trustee Linder?
Aye.
I vote aye as well. He is approved unanimously. Similarly, we have one nomination for chair. I wouldn't say it commends the wisdom of the board, but that nominee is myself. If there's any further discussion or comment, seeing none, we will have a roll call vote. Trustee Faulkner?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Jennings?
Aye.
Trustee Linder?
Aye.
And the chair will abstain.
There's a comment.
There's a comment.
All right.
Spencer, comment.
Okay, sorry, was that Mr. Imamura? There's a comment, I believe, on which item, 5F or 5G?
Yeah, well, this is 5G, I fully support you and appreciate you being the chair again. The other motion you made for vice chair, I totally oppose. I believe Mr. Chandra is totally out of touch with the stakeholders. He doesn't even live here. He can't even stay for one meeting. And he lives in the most expensive zip code in the United States. How is that in touch with the average retiree and taxpayer in San Jose? Thank you.
Okay, thank you for your comments. I'll simply remark that Trustee Chandra has been a dedicated trustee to this board. He's not here to defend himself, so he has given enormous amount of his time and energy to this board over the course of 9 years, I believe. He's our longest-serving trustee.
I would also like to add that Trustee Chandra has investment background, which adds to the board itself. Just for an awareness, asset allocation is a strong matter that we have. He is also on the investment committee, and he is very dedicated to the city employees and stands for the city employees. In my last tenure of 4 years, I have seen that come forth, and I am a strong employee voice, and I support him 100%.
Let us proceed to item 5H, discussion and action on a adoption updated city policy manual for employee travel. Are you going to present on
Yes.
this one?
So I'll make comments on 5H and I. You'll have to vote separately, but these are two minor updates to city policies, part of our notification through the city manager's office when policies get updated. The executive team reviews that. If we have no concerns, we'll bring it directly to the boards for recommendation for approval. In both of these cases, they were minor updates. For the 5.H, they added wording such that it was the lowest reimbursable, word reimbursable was added, amount for hotels. And for 5I, they increased the recognition amount that we can spend per employee from $35 to $40, I believe. So those are the accumulated updates for each, but you will have to vote on them separately.
All right, are there any questions about the changes in policy, either travel or employee recognition? If not, I'll entertain a motion to accept the changes to the employee travel policy.
So moved, Mr. Chair.
Motion- Thank you. Motion from Trustee Linder, a second.
I second.
We have a second from Trustee Abbott. Any discussion, any public comments? Seeing none, we can vote. Trustee Faulkner?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Jennings?
Aye.
Trustee Linder?
Aye.
And chair votes aye. Similarly, I'll entertain a motion to adopt the updated employee appreciation and recognition policy. Do we have such a motion?
So moved, Mr. Chair.
Thank you. A motion from Trustee Linder. Do we have a second?
I'll second.
We have a second from Trustee Abbott. Is there any further discussion or public comment? There is none. We will have a roll call vote. Trustee Faulkner?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Vice Chair Jennings?
Aye.
Trustee Linder?
Aye.
And the chair votes aye. Good. We're on to committee reports. Investment Committee. We did just have a meeting, and IC Committee Chair is not here. I guess I can speak to that, or you can. We reviewed a number of items. We reviewed the an annual review of our foreign exchange expenses, annual review of our trading expenses, a review of private markets performance, and
we also, I think, went through a sample due diligence.
thank you, we did a
item.
sample
Yeah.
due diligence. It was all very informative. And I guess we can accept the minutes, and we don't need a vote on that, correct? So we'll receive and file. Audit Committee, Chair Avasti is here.
The last joint audit committee meeting was on August 15th, and the next meeting is on February 20th. We have an action item here related to management letter comments and recommendations regarding the audit findings. I believe this item was not discussed in the joint audit committee, and the committee allowed to take it directly to the board, so this has not yet been heard by the audit committee, so I'll let John present on that.
Actually,
like-
I'm gonna have Dinesh speak to that item.
Thank you. So this is related to the ACFR. There's a number of exhibits with a lot of different information that's included in the financial reports. And this year, MGO, the auditor, had one recommendation for us, and this is related to unfunded commitments for alternative investments. So what unfunded commitments are for private funds. The managers have the ability to call capital, and this is the amount that the manager could potentially call. And in the course of the auditor's testing, comparing what we report versus what the managers report, they found some differences. They noted it was not material. It amounted to about $10 million. And there's two reasons for this that we were already aware of, but they pointed out here in this letter. First is the timing, because this is as of Q2. Private investments have a lag in their valuations, and it takes time for that to be processed. And just today, you got the Q2 2024 private markets report, so that's one part. The second is the methodology used by the consultants. So Makita uses the cash flow statements, and in some cases, those can be incomplete or have different information about what could be a recallable contribution. So those two reasons contributed to these differences of about 10 million. The auditor's recommendation was that we review our processes, and we've actually already done that. So we've taken two steps. First is that Makita, for the June 30th numbers, they're going to accelerate their timeline for finishing data gathering and data analysis. Secondly, they're going to do a comparison to the manager's reported unfunded commitment amounts to eliminate differences. And thirdly, we internally as staff will also do a review to ensure that there's no differences in this particular table. So happy to answer any further questions, and we're also looking for action today.
Can you explain what a recallable commitment is?
So it's actually a recallable distribution. So during the investment period, when an investment gets realized, the fund has the ability to recall that capital to make further investments during the investment period.
Okay. Any questions from trustees?
I have a question. So with this procedure change, do you expect that this lag effect will be eliminated in the future with the new procedures, and these discrepancies will not be there?
As much as possible. So up to the point where we finalize the ACFR, we'll continue to input updated data. So our expectation is we should have all or nearly all data included for future years.
And again, you said the auditor found this a non-material
Yes.
in terms of the amounts. Okay. Right, so we need action to approve the letter or to receive the letter?
I think it's an action item.
It's to approve.
To approve, okay. I'll entertain a motion to do such.
I'll motion to approve it.
Okay, we have a motion from Vice Chair Jennings. Do we have a second?
I second.
Second from Trustee Avasti. Any further questions or comments from trustees or the public? Seeing none, we will have a roll call vote. Trustee Faulkner?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Vice Chair Jennings?
Aye.
Trustee Linder?
Aye.
Chair votes aye. The letter is approved. Governance Committee, Mr. Linder.
Well, we're meeting today.
Okay.
After this meeting, it'll be a joint meeting.
Mhm.
There's a couple policies we're working on.
Okay.
And I am so confident because Maytech says she doesn't need to be here.
Well.
Mr. Flynn can handle it all. So that gives me great confidence.
Okay.
that this will go pretty well today.
Okay, I am optimistic.
Yes.
Which leads me to the Disability Committee and Mr. Linder.
And we meet again on February 4th. We'll have probably 3 or 4 candidates for disability retirements that we'll be taking a look at that meeting.
Okay, great. And these are 2 new agenda items, the Legal Services Joint Ad Hoc Committee. We have an oral update. I guess Trustee Abbott, you're the only one here to provide that.
Well, except I just had an update from.
Oh, there's a late breaking
our-
news,
our
okay.
CEO, so.
Yeah.
Sure, I can give a brief update. So we sent the draft, the committee finalized the draft RFP. I sent it over to the city attorney's office for review. City attorney got back to me yesterday, and I believe we'll be able to recommend that we publish this RFP by end of day tomorrow.
Say end of day tomorrow? you
End
said?
of day tomorrow, yes. The city attorney's comments were minor. Actually, there was a little bit of praise the way we have broken down the services, and then some minor update where the RFP refers to, there's a section that refers to goods, and the legal is just services. So it's not required. So we're working to pull out some of those goods-based languages, but
Okay.
really no substantive changes, which was very positive. And
Attorneys
I-
always have to make changes. If they
And
don't
I-
make changes, then they didn't
we
review
put a
it.
strong turnaround time on that, and I really appreciate the city attorney actually pushing that forward so that we could meet our deadline to get this out by tomorrow.
Okay, great. And I assume that's on schedule for the schedule that was originally published?
We'll have to tweak the schedule, but there'll be time.
Okay, we're pretty close. And I guess it's,
just wanted to add, I think
Mhm.
that, we at one time had said that we were gonna be done with everything by June, and I think we're looking at having selections made by April, which gives us time to onboard our legal.
And to negotiate the contracts, right? Because, we could be negotiating a number of contracts off of one RFP, and so just having the time to do that as well.
could be a busy spring. Okay, any questions from trustees, or questions or comments from the public? Very good, thank you. And similar with the Actuarial Services Joint Ad Hoc. Trustee Avasti or Mr. Flynn? I mean, where are we
I'll
with
give
that?
deference. I'm willing to speak.
We had a kickoff meeting a couple of weeks back, and the staff is working on the RFP, and we are waiting for the results to be
Okay.
out. And
So the direction from the ad hoc committee was to have staff take care of the development, the posting, and some of the administrative pieces up to including making sure we have qualified candidates, and then we will bring it back to the committee. So
Got it.
we are, I believe that we are on track to also have that published by tomorrow. Again, all of these deadlines, we're trying to get ahead of the holiday closure, so that
Sure.
we could get that out on the street and abide by the timelines required. So we're really close for that to go out as well. So I'm pretty happy with the progress that we've made on both of these.
Is there a concern that by publishing them so late in the year, or coming into the holiday period, we may not have responses as timely as we might otherwise have had?
We believe that, so the first step in the RFP process is for them to submit questions, and I don't, those questions I don't think are due until into the first week of January. So
Okay.
there is time there for consultants. I will be reaching out to all, on the legal services, I think there were 35 different firms that Benji and her team were able to identify that are servicing other California pension funds. On the actuarial services, it's a much smaller group, only 3. And so, 2 of which we have contracted with during the last procurement. So that's a much smaller universe, but we will be reaching out to them.
Got it. Any questions or comments from trustees and/or the public? There are none. Very good, thank you. Education and training, we can all see what's available. Calipers General Assembly is coming up, and right on its heel, the Pension Bridge, which brings us to any proposed agenda items. If not, we are in adjournment. Thank you.
Thank you.
A Merry Christmas to all who celebrate, and we will see you
Recording
all
stopped.
in the new year.
To all good night.
So how do we,
Yes.
we unpack this?